All right. Good morning, everybody. Good morning, Cav. Nice to see you. Grant, were you able to fix it? I hope. I don't know if you're still in here. Lyle, were you able to hook up? Gino, were you able to get where you needed to be? Good morning, Andy. Nice to see you. Good morning, Miss Adriana. Great to have you. Hope everybody had a good weekend. Maybe you're a little worn out, sunburned, hungover, whatever you need to be to make you happy. Good morning, Dwight. Good to see you. Googly Moogly, it's Monday. Who was the original Great Googly Moogly, Gary? That was oh man, it was a Hanna-Barbera cartoon. I can't remember who. Good morning, Bob L. Good to see you, man. Great to have you guys here today. Hope everybody's doing well. March Madness starts. Man, I'm just not a basketball guy at all. Lyle, you did get it taken care of? Good. You got money to make, Lyle. Can't have you having challenges, so guys, remember, you can always ask for tech help in here. You can always ask me to see if maybe I have a fix for you. I'll do my best, I promise, but I'm the worst tech guy in the world. The chances of me being able to fix it are typically slim to none, but every now and then we get lucky and I have a picture in the archive or I have something going on that may be a little helpful. So um, always ask. I mean, it never hurts to ask, never at all. So guys, we're gonna do some stuff today. We're gonna talk a lot today. We're gonna talk about patterns today. Um, I'm going to I'm gonna cover something. I got the best message this weekend, and it talked about sitting in front of your computer. And I want to throw this out there because this is a 3 hour class, guys, and you'll notice that I break it up. You'll notice that I stand up and just tell you I'm gonna go scratch the dog behind the ear or refill my water or something like that. The more you focus on something, the less focused you become. So, guys, don't be afraid to incorporate breaks into your day. Don't be afraid to stand up and walk away, especially if it's been a while since your rules have been met. Human nature kicks in very much. And when your indicators don't tell you that it's time to take a trade, that little devil on your shoulder will help you fabricate one so that you don't have to sit still. So when you feel that, don't be afraid. So we're going to take breaks twice today. Guys, take it with me. Just something to think about. Good morning, Roku. It's good to see you. All right, guys, today and every day we are going to check news. And we're going to go to forexfactory.com and see what's going on. But hold on, I have to take one more picture to put in the series. All right. Because I have been following this and turning this into a lesson for you guys with the NASDAQ. So you guys that took shorts, I want you to show them to me. Every morning I check news, guys. Every morning I go to forexfactory.com and I'm like, what's happening today? What's going on that might make the people that move the market jump around? And today at 10 a.m., there is the housing market index, but it's low impact and it's really not anticipated to create problems for us. I'm looking for medium impact and I'm looking for high impact. Wednesday is where it really kicks in, guys. Wednesday afternoon will be a great day to golf because when we've got these medium and high impact news, what happens is there's some guy sitting on a pile of money and he goes, I'll tell you what, if the building permits is a good report, I'm going to go long. And if the building permits is a bad report, I'm going to go short, or vice versa. We never know what they're going to do. But what happens to us, the smaller fish in the pond, is more often than not, we just get run over. And we get run over so quickly that we get slipped. And $100 losers turn into $400 losers. So knowing when news is going to print, guys, it's a huge advantage that you can give yourself every day to just stay out of the way if that's the choice that you want to make. Huge disclaimer, I will not tell you when to trade, how to trade, what to trade, how many contracts to trade. I won't tell you when to enter or when to exit. My job is chart reading. And that's what I do every day, guys, is we just talk about chart reading. And that's the first thing that we talk about because it's the most important thing. Um, you know what? It just does. So every trade, and this is, I don't know if you guys know this. So, Cav, every time you go long, somebody's got to want to go short. There has to be the other side of that trade. One of you is going to lose. So, when maybe there's 1,000 contracts short, I don't know, and I may be making this up. You'd probably get it better on YouTube. Somebody dumps 1,000 contracts short, right? If you're in a long position, you get run over because they go short, and then everybody else sees them go short, and they go into short positions. And what happens is everybody with a long position starts to get wiped out. And when you put that sort of volume into it, it not only wipes out the people that are already in the market, but it wipes out the people with orders waiting as well. They get the other side, and it spikes, and that's my uneducated remedial version of why that happens. But the bottom line is, it's like a bazooka full of orders, and if you're against it, you're going to get flattened. Um, I guess the short answer is I don't know the exact whys. Like I don't know the formula that makes that happen, but I'm sure you could find it. But the more people buy, the more the market goes up, and the more people sell, the more market goes down, and the market is easily manipulated by deep pockets. So that's why we trade patterns. Great segue though. That's why we trade patterns, guys. And in order to trade patterns, you've got to be a chart reader. And that's what we're going to focus on for the first hour. This is actually our focus for the first hour every day, guys. There's really not a lot of deviation in the first hour, Monday through Friday. We talk about becoming a chart reader. We talk about being able to read your indicators and understand the message that they're giving you. Chart reading is about 90% of your day. It is 90% sitting on your hands waiting for advantages, and it's about 10% of trading. But when you're a good chart reader, when you understand chart reading, do it well, pardon my English, you'll understand where the market is likely to continue. And this continuation point will become an entry for you. You'll understand where the market is likely to go. It's going to help you make intelligent choices on profits. And you'll also understand where the market is likely to stop. And likely to stop areas are what we call termination conditions. And a termination condition can stop the market. Good morning, JW. It can reverse the market. It can create a fight. And you're going to get a very simple recipe, a very easy recipe to understand when you've reached one of these likely to stop areas. And I'm going to tell you guys right now, and if you're the note-taking sort, you will realize that termination conditions, areas that may stop the market, the recipe for identifying them is pretty simple, but it takes a while to trust them. It's the most broken rule of all the rules. People love to hope that areas break. Good morning, Grant. Grant, did you get that fixed? I hope you saw the picture that I put in there. My brother gave me that picture because I had the same thing going on. Awesome. Good stuff. Like I said, guys, I'm the worst tech guy, but I've seen a lot of stuff, so maybe I can help out. So we're going to focus on chart reading, guys, and that chart reading is going to take you to your trade entry precision. And we're going to do this with what's called a high probability trend trade. Good morning, GWC. And a high probability trend trade is a trade that typically wins 70 to 80% of the time if you follow the rules. A high probability trend trade is a trade that creates confidence through the memory of success. Good morning, Zorro. Good to see you in here. And guys, hey, 10K. Man, I got all the kids in here today. I love it. A high probability trend trade, guys, is dependent on chart reading. So that's why we cover it first, because the chart reading that you establish, the abilities that you create through understanding the high probability trend trade are what's going to carry you to the next level. It's what's going to help you find that next trade, more trades, better management, and all that good stuff. And a high probability trade simply means that each indicator on every chart agrees for the trade. Guys, this is when your triggers are the strongest and there's nothing in the way, none of those likely to stop areas. There's nothing between you and your target. And the high probability trend trade, I want you to give me 20 days. Let's focus on just great entries. Understanding the advantages, embracing them, finding the entries, and then from there, you will just go gangbusters, guys. And once you know how to get into the market, management's your next step. Now, I'm going to give you solid plans, not only for the high probability trend trade, but also for a medium probability trend trade. We're going to talk about management today. We're probably going to talk about psychology today. We're probably going to talk about good stuff and bad stuff and strong trades and weak trades. And man, everything's going to revolve around chart reading. So I want you to remember that as we get into the day, as we get into the week, as we get into the next 10 years of your life, chart reading is really what we're focused on. And the easiest way, the step-by-step path to becoming a confident trader is becoming a confident chart reader. And becoming a confident chart reader necessitates that you post your trades in class. Everything that you do, guys, every time you take a trade, you're going to drop it in the room. And when you drop it in the room, you're going to tell me, what you saw, what kind of trade it was, where you entered, where you exited, and then I'm going to give you feedback on your chart read. And I'm going to say, man, Gary, you had a beautiful termination condition and none of the triggers rolled through. This is a great lesson on where the market is likely to stop. I said you were patiently waited for your large triggers to roll, for your small triggers to roll, and then you use that high volume area line to really take the easiest trade possible. And I love how you exited right at the problem spot, right at the area where the market is likely to stop. And Gary's going to strut around his room for a little bit. He's going to go, man, that was a great trade. That was a rules-based trade. That was the kind of trade that I need to find every day because that's the one that's going to get me paid. If you're brand new, the more information you put on the chart, the better the feedback is going to be. Tell me what you saw and why you did it. Gary's been with me a while, so he knew that I knew his rules. Tell me your chart read because that's what we're focused on. But the more you post in the room, guys, the quicker you're going to get to where you want to be. And then the second thing is Nexgen gave you a spreadsheet. I'm going to drop mine in the room right now. But the spreadsheet is a 3 tabs. I'm going to open this up. Your first tab is a trade journal. Every time you take that trade, so Gary's going to take his trade and he's going to drop it into this spreadsheet. And he's going to talk about the conditions, how he felt, and if there was some feedback. Maybe I said, Gary, you were a few ticks early or a few ticks late, or Gary, I want you to notice how you fought this condition and it made it a little disadvantageous. He's going to put the notes in there so that he can come back and look at it. But since it was perfect, Gary's probably going to put it in his favorite look section. And he's going to say, this is the high volume area trade that I never want to miss. And then for you guys that are studying, Jen, Zorro, David, Chris and Jamie, all you guys that are like, man, there's a lot going on. I need to get better. I need to see these looks. There's a third tab, and this is where I've put about 300 pictures of trading that you guys have done. Hey, good morning, Miss Jen. Good morning, Mario. This is where you guys are showing me what you're doing, where you're talking about your reads, where you're showing me just really how awesome you are. And at some point you dropped it in the room and I said, holy smokes, this is everything that I look for. I'm going to take this trade. And sure enough, you can go back through that spreadsheet and you can begin the process of recognition through repetition, even before you take pictures. But the easiest way for you to get to where you want to be is to commit to 15 pictures a day, commit to 20 pictures a day. Every time you see strong triggers, take a picture of it. Write strong triggers on a chart. Burn it into your brain. Every time you see a termination condition, I want you to take a picture of it in the beginning and go, hey, this is where the market is likely to stop. And what happens is you stop being surprised when you lose trades into areas that may stop the market, or you stop being surprised when you try to trade against momentum. And it really just opens the door for you to speak to yourself in terms of advantages because you recognize them right there in the moment. So post your trades in class. You can't post too many times. You can't write too much on a chart. You can't ask too many questions, guys. The first hour is very lecture-y, but the second and third hours revolve around your pictures and your requests for feedback. Learn the trigger line of Fibonacci rules for when it's okay to trade. That's what we're going to do for the first hour. We're going to talk about the high probability trend trade. We're going to talk about the advantages that create it. We're going to go back and look for it, not only through pictures, but also in the live market. Guys, simulate every day. Don't be that person that says, well, I want to know it perfectly before I do it on simulator. I'm going to tell you right now, the more mistakes that you make on simulator, the quicker you're going to get to where you want to be, especially if you drop them in the room so that we can talk about the chart reads. My goal for each and every one of you is that you practice the correct rules, that you focus on advantages, because so often I see people become simulator millionaires. I'm going to take risky trades just because it's simulator. I'm going to fight all these things just because it's simulator. And guys, the testicular fortitude that you have on simulator rarely translates into long-term success. It typically sets you up for failure. So I'm going to focus on it. Even you experienced people, when you drop something in the room, for example, some of you have plans where you may trade into termination conditions. Don't get your feelings hurt when I tell you, hey, you traded into a termination condition, because the class is for everybody. And I'm always going to revolve around advantages. We're going to simplify heavily. We're going to talk about the high probability trend trade. That's going to be the focus. Guys, this is your bread and butter. This is the one that's going to set you up for long-term success. I will introduce you to what we call a medium probability trade, how to understand when you're entering a medium probability trade. But the idea is that you have to know what looks you're going to commit to. What's it going to take to get me into the market? And then you're going to take pictures. You have to learn them so that they become easy. The easiest way to do that is if nothing is moving and I'm not in a trade, guys, this is what a good top looks like. This is a strong top. That's just a clever way of saying a termination condition, area likely to stop the market, that reverses the market. If you look at 10 pictures of a good top when absolutely nothing is moving, it becomes easier to recognize it when the market is live. Strong triggers are always strong triggers, but there's movement in the triggers. So if you snap this picture when everything is perfect, you know exactly what you're looking like. The same with termination conditions, entry areas. The more pictures you take, the easier life becomes for you. So we're going to get into the high probability trend trade. And it starts with strong triggers. Everything should start with strong triggers. Strong triggers give you the advantage of momentum. And that's the clever way that the high probability trend trade works. Each rule provides an advantage. Your first rule gives you momentum. The second rule gives you a clear path. And the third rule puts you in at the best of the best spot where the market is likely to continue. So this is the one trade that creates advantages through every rule. That's why we focus on it, because it's the recognition of these advantages that makes you a chart reader, that sets you up for long-term success. So the first rule is strong trigger lines. It's going to give you momentum. We're going to use two charts today. Again, disclaimer, as you learn to read charts, you may add another time frame. You may add a different style chart. You may look for bigger moves on higher time frames, but the patterns that I teach are going to be repeatable anywhere you look. So we're going to keep it simple, we're going to keep it focused, and we're only going to keep it on two charts. The large chart is a broad stroke of a brush. It's a slow moving chart. This is molasses in January, and it will bore the ever-loving snot out of you as you wait for a trade, because everything that you need to look for an entry is revealed on the most current bar on the large chart. This one bar will define direction, it'll define momentum, it'll define areas, and it gives you the overall opinion of the market, I believe is the best way to say it. But it's what the large crowd wants. Your large chart is what the large crowd wants. The people that push the market, that establish trends, that give you momentum, the people that react to those key areas that may stop the market. That's the large crowd. Commit yourself to never fighting the large crowd. And then once the rules are met over here, once rule number one is in place, then you have the advantage of momentum. And once rule number two is true and you have a clear path, nothing between you and your target, you turn your attention to a smaller, faster chart. And this is a refinement chart. What happens in one bar on the large chart, maybe 15, 30 bars on the smaller, faster chart. We use that refinement process so that when everything says up with momentum and a clear path, this small chart allows you to buy low, to use Fibonacci support on that smaller, faster chart to enter the market. Or when the large chart says down with momentum and strength, you're going to be able to sell high on the smaller, faster chart. You're going to use a little pullback, and it's going to reduce your risk. It's going to maximize your profit potential. And rule number 3 is designed to get you in at the absolute best of the best spot, but only when the first 2 rules are met, when the large chart has done its job. So we're going to talk about strong triggers. That's the first rule. Large chart must have strong triggers. Strong triggers provide the advantage of momentum. Momentum will push a market in the direction of the trend. If the background is green, the market's going up. If the background is red, the market's going down. Those strong triggers can break key Fibonacci areas, and those strong triggers can actually cover some of the mistakes that new users make. So in order to have strong triggers, you have to be going with the direction of the market. If the background is green, you should only be looking for long trades, buying the market. If the background is red, you should only be looking for rules to be met for short trades. Because strong triggers can only happen if the colors match. You know, it took me 2 years to kind of put this together, but this is a great safeguard. Oh my gosh. Gary, that's a lot. When my background is green, it means that my small triggers, the solid lines, and the large triggers, the dashed lines, well, they have to be green as well. And when they're both green and they're both wide and they're both in the direction of the trend, well, now I can get that strong trigger look. But the final part of it is when the smalls break above the large triggers, when it creates this look like scissors opening. Guys, this is your strong trigger look. This is the best of the best. This is a market where the odds are favorable for it to continue up. This is rule number 1 defined right here in pictures. And when rule number 1 is in place, when I have the best of the best momentum, that is when we are going to refine on a smaller, faster chart. We're going to buy Fibonacci support. On the large chart, it looks like a tail or a wick. We're going to use these tails later so that we can go back and study, but we don't trade these tails or wicks. We use the momentum knowing that that's the best case scenario to buy Fibonacci support on a smaller chart. Or if the market's going down, if the background is red, small triggers are below the large. Both must be wide and angled in the direction of the trend. And it's the space created, like scissors open, that let me know that the odds are favorable for the market to continue down. You're going to hear odds favorable momentum all day long. You're going to see me annotate charts OFM because odds favorable momentum is the best of the best, guys. Every trade that Nexgen teaches revolves around momentum in some shape or form. Momentum can break key areas. Momentum covers mistakes, guys. Momentum is the one that I just don't let go of. But it requires a little patience because 90% of your day is waiting for the best. As the brand new user, the odds favorable momentum is the best of the best for short trades when you're going to sell resistance on a smaller, faster chart. As you begin to learn to read your charts, you're going to notice that when both triggers are down and one of the small triggers is inside of the large triggers, you're going to recognize this through chart reading as the first loss of momentum. You're going to say, my advantage of momentum is going away. Short trades may still be taken if the other charts agree. And then when both of the small triggers get inside of the large triggers, guys, this is a weakening or a slowing of the trend. Your advantage of momentum is out the window. It's no longer existent. This is what we call anything can happen triggers because anything can happen up or down. The weaker the triggers, very often, the bigger the retracements, even if the market continues down. The weaker the triggers when you reach Fibonacci areas, the more likely those areas are to hold. So for the brand new user, commitment to momentum is one of the best advantages that you can give yourself. As you grow with the software, you'll begin to recognize through your chart reading more opportunity. And then those weak triggers right at key areas. This is our segue into rule number 2, which says termination conditions false, that you don't trade into those areas likely to stop the market. And that results in room to your profit targets being true. So rule number 2, by not trading into termination conditions, establishes a clear path, nothing between you and your target. The large chart has already provided the direction of the market. It's a green background, the market's going up. The large chart has those scissors open, everything agrees. The momentum is established and rule number one is in place. So now we're going to make sure that the large chart is not trading into areas, not trading into places that may stop the market. So I'm going to go through what is a termination condition. Let's do the textbook real quick. A termination condition is a Fibonacci-based indicator. Guys, you don't even know what Fibonacci is. It's a line on your chart. And it may reverse the market based on a comparison of that area in the T3 trigger strength and location. So the areas on your large chart that may be problematic, that may reverse the market, that may stop it, or actually that may break with all the momentum is going to be blue Fibonacci support, red Fibonacci resistance, yellow 1-to-1 dots, cyan divergence low lines, magenta divergence high lines, as well as a mid band when the large triggers are a full bar away. So these are the areas. Here's kind of your little visual. These are the areas where decisions are made, and this is what I want you to get out of termination conditions. Decisions are being made at these spots, guys. This is where the buyers buy, and this is where the sellers sell. This is where the large crowd makes the decision on whether or not they want to continue or it's time to jump ship. These lines can cause trouble. We will use the trigger lines and they'll let us know if those lines are likely to stop the market, if those areas have the potential to break, or if they have been broken. Your trigger lines are going to determine that, and you're going to be able to do that with a very simple recipe. And I'm going to take a picture of the picture so that we can walk through three potential scenarios here. The first one is identifying a termination condition. It's right here in black and white. After price reaches any Fibonacci support. So remember, decisions are being made at key areas. I can't stress this enough. Decisions are being made, and when price reaches the area, it sets off the decision-making process. So when price reaches Fibonacci support, check your trigger lines, and if they're not below the support, don't take any more trend trade shorts on the small chart. Don't trade into an area with the triggers above. Good morning, Luciano. That, my friends, is a textbook termination condition. The same is true up top where it hit that support and none of the triggers have broken yet. That's a termination condition, and all that means, it's a four-letter word, guys. It's going to make you sad. But it means wait. Wait to see what the decision is. Wait to see if they decided to create an untradeable bounce. There it is right there. Wait to see if the sellers are going to push through the area. Wait to see if it's going to reverse the market. The reality is, and I need you to accept this right now, is that you don't know. You never know what the market's going to do. It's nothing more than an accumulation of up and down ticks, but we're trading patterns and looks that offer us a chance at success. So when price reaches the area and absolutely no trigger lines break through, it's okay to sit on your hands and do nothing. It's okay to say to yourself, I no longer have a clear path. Guys, price reached Fibonacci resistance here in the NASDAQ, and look at the rocket off of it. Nobody had to go long, even with strong triggers, because your rules said that this may stop the market. It may create an untradeable bounce. Price reaches Fibonacci resistance, the triggers are weak. The bounce is there. And I want you to see something. If you don't think that the people in charge know where these areas are, I want you to see Fibonacci support that sets off the market going up. And they ignored 1, 2, 3, 4, 5, 6, 7, 8. They ignored 8 areas. Good morning, Luciano. And they stopped cold and bounced right at a key Fibonacci area. Guys, they had their number in place before they ever started. Price touches. So Haji, the lines aren't wide enough for a full bar, right? So once price touched it, once price reached Fibonacci support and the triggers were all the way up here, this is a termination condition. It's still, even though it goes through, notice that the triggers aren't still through support. The reality is, Haji, is you don't know if that area is going to bounce. You don't know if it's going to hold. You don't know if it's going to get blown through. And you just don't have to guess. And I want you guys to see this. I took pictures this morning. Price reached Fibonacci, reached the fib, right? The bars make it, and that's the same exact look. And all the triggers remain above. And you're just thinking to yourself, man, it looks like it should be a short, but the path isn't clear. And I want you to see what happens in that one bar right at the fib that the triggers aren't through, guys. Up, down, up, down. And this went up, down again. And this is all of the indecision. This is the fight right at the key area. You guys don't have to be a part of this fight because rule number 2 said don't try the short. Sure enough, the smalls break through, but guys, the area never breaks. And it's this patience piece. Just saying to yourself, I'm not sure. I don't have to be in the market. 90% of my day can be spent reading indicators. 10% of my day can be cashing in on the advantages that are present. So when price reaches an area and the triggers remain above it, sit on your hands and do nothing. And then it's cool to go when both the small and the large get through an area, guys. Now the area is broken. And I want you to see this. Remember, it's one bar. That's the most current bar. So if we're looking just like this, our most current bar has both triggers below support, and now it's behaving as resistance. Our most current bar has odds favorable momentum, which means that that's the best of the best look to buy or to sell Fibonacci resistance. There's that tail on the smaller, faster chart. And then the goal is that we ride that wave of momentum all the way down to where the market is likely to go. The triggers need to break, Jen. So when the small and the large break, support becomes resistance. Guys, don't be wooed into that red, excuse me. The fib is red. So you're thinking, oh my gosh, I should go short. But the reality is until small and large get to the other side, it's not broken yet. And that brings me to my final look, guys. When your small triggers smash through the area, and let me write this right in the middle. Odds favorable momentum is mandatory. When your small triggers get 2 or 3 points below the area, not some little, they're eking over and I really want to be in a trade. Guys, when they scream through that area with odds favorable momentum, but the large triggers haven't made it through yet, only 50% of your triggers have made it through, 50% are lagging behind. This will be your first medium probability trade. And guess what it's called? The 50-50 trade. And what does that mean? That means with odds favorable momentum, the area has the potential, let's go in all caps, the potential to break. But it is not, all caps again, broken. The path isn't clear. Rule 2 isn't met. It can't be a high probability trend trade. Guys, this is going to be the look when those trigger lines have the potential to break the area. But it's not broken until small and large go through. Is everybody comfortable with that? Give me a Y in the room, because I want you to see this again. No triggers through, the beginning of indecision. You see it on the smaller, faster chart. Small triggers through, now it has the potential if you get the rules met for a 50-50. And I want you to see what else I posted in. Guys, this is not my best look for a 50-50. And look how the market never broke. Isn't that unbelievable? One simple rule keeps you from taking the loser. One simple rule keeps you from hoping that areas break, because all you really have to do is wait for them to break. And guys, this is one of the things that I'm trying to sell you the absolute hardest, is that we are freaking brilliant and we know where the market may stop. We can see when it may bounce, and check it out. Eventually it breaks. There's the potential to break. And then once the small and large get above, look at that little tap back. Where resistance breaks, it becomes support, and the market just clicks off of it to the freaking tick. Guys, they know where these areas are. You know where these areas are. All you have to do is become a chart reader so that you can capitalize on this look right here to take the market up. So That's really what we're talking about right now, guys. We're talking about give yourself a clear path, give yourself an advantage. It's not every day or every second of every day. 90% of your day is waiting, being patient, and then capitalizing on the momentum, capitalizing on the clear path. So this is a great view, guys. Price comes up to resistance, and absolutely no triggers break. And even though the smalls are peaking above the large, each and every one of you in this room said no long trades for me. This is an area that may stop the market. I don't know for sure, so let me sit on my hands and let's see what the large crowd does. And the large crowd pushes all the way down to support. We also get one of these divergence highs. And I want to talk about what divergence is. And you know what? We're going to take a lot of pictures today. We're doing the Monday class today. This magenta line from a high pivot means that the sellers stole momentum from the buyers. It's a loss of momentum. That's all it is. This line is not a termination condition. How come? Because price creates it, price doesn't reach it. And the recipe for a termination condition is price reaches the area. So this loss of momentum, guys, what this does for us is it says, hey, the sellers didn't want the buyers to go any higher. Not only did they push against them, but they stole their momentum. Look at the pink line. It's just a loss of momentum, and that divergence isn't true until about right here on the third bar. But this line's going to come back into play because the sellers are able to push all the way down to this key Fibonacci area, but all the triggers are up here. Large triggers are a full bar away, guys. This just kind of assures that there's no way I'm going short. We call this the gap theory. When there is room for a full bar to get back to those triggers after an area is reached, they accelerate away from the large triggers. It's likely to close the gap. It behaves like a vacuum. Triggers are nothing more than moving averages, and price loves to correct back to the moving average. So we're not going long into this termination condition. We're not going short into this termination condition. Guys, 90% of your day is spent reading indicators. Support, the buyers fight back, right? The market's nothing more than ups and downs, fights. But notice the look when they get into Fibonacci resistance. Now I have weak triggers. Do you guys remember that first picture? Weak triggers at an area it's more likely to hold. It also reaches the divergence high line. Whoops, wrong one. And all the triggers remain below. That's a termination. Now this magenta line is behaving as a termination condition. And when price trades above the divergence line and then back below, guys, don't take any long trades. This is what we call a pivot stop out of a divergence high. It's powerful. And then when Fibonacci resistance is true, when those terminations are true as well, 1, 2, 3 of them, this is a look that's likely to reverse the market. And when it does, when my small triggers get below the large roll, they roll and they're angled down. Guys, this is what we call a strong top, tie-up. And a strong top is the precursor to the highest probability trend trade that you can take. So when I get a strong top and I end up with momentum, and that bar hasn't reached Fibonacci support, welcome to Nexgen, guys. You're going to pinpoint exactly where the market is most likely to continue. You're going to sell high at Fibonacci resistance on a smaller, faster chart, and this is going to allow you to take advantage of a strong top to ride the wave of momentum to the key areas and beyond. This is what we're focused on right now, guys. The idea that a little bit of patience typically results in results. Price reaches one-to-ones. Does everybody see? Price reaches the area, decisions are made. The decision was that the buyers are going to push hard. Look at the size of that bar right off the termination condition. There's just no reason to get caught in a short there, guys. Any short trade taken into this area is hope. It's wishing, it's wanting. And we're going to go back to the wisdom of my father-in-law. Wish in one hand, poop in the other. Tell me which one fills up first. One hand always fills up first. Right off of these one-to-ones, it goes into resistance and all the triggers are below. So I can't go long either. I couldn't go short. Well, I could, but it was financial suicide. And now I can't go long. I shouldn't go long. My rules aren't met. And then the sellers push back. Notice that the trigger lines don't match in color. I can't have momentum either direction because they're different colors. I can't go long into resistance with none of the triggers through, and I can't go short into yellow 1-to-1s. Guys, this is the 90%. This 90% goes on for about 45 minutes. 45 minutes, the market doesn't give you clarity. 45 minutes, your rules aren't met. But eventually, you end up with odds favorable momentum. You end up with both sets of triggers above resistance. It's behaving as support. And there it is right there, each and every one of you buying Fibonacci support on a smaller, faster chart to take the highest probability trend trade possible, the one that wins 70 to 80% of the time, the one that creates confidence through the memory of success. And not giving up $1,000 in the chop and the consolidation makes it easy to hold on to the money when it's absolutely perfect. So guys, this is what we're talking about today. Let's recognize advantages. Let's recognize momentum. And when decision-making spots are reached, let's let them make their decisions. Is everybody cool with rule number 2? Price reaches. It's so important that you understand that price reaches. That sets off the decision-making process. And when price reaches the area, there's going to be 3 potential options. No triggers through, the area is not broken, and the path isn't clear. Small triggers smash through with odds favorable momentum. It has the potential to break, but it's still not a clear path. Smalls and large get above the area is now broken, the path is clear, and rule number 2 is met. So new users, the first slide and the third slide, that's your path to glory. Eventually you're going to add this one in, and I want you to see something. You still got a pretty big deep pullback because there's almost always a fight at key Fibonacci areas. Almost always. Not always. And then guys, sometimes the market turns from nowhere. We rely on Fibonacci to let us know where the market is likely to go, and we rely on these areas to understand where the market is likely to stop. But sometimes with everything down, it goes up, and with everything up, it goes down. I'm going to give you a termination condition that you're going to see on a smaller, faster chart. You're going to see this on your 5-1. And this termination condition is the only termination condition on a small chart. This is the only condition that can tell you that rule number 2 is not met. Your rules aren't met, not taking a trade. And it's 3 divergences in the same price range. 3 losses of momentum in the same price range. You'll see it on a low because that negative number prints. And that cyan line, that light blue line, extends off to the right. Little heads up, that negative number is an arbitrary number. It's a byproduct of the calculation that runs behind the scenes to give you that cyan line. But if you see it, you know divergence is true. If you see a negative number on your charts and it's changing numbers and you don't see a cyan line, that's the potential for divergence. But guys, we don't trade potential. Divergence must be true. So 3 divergences, 3 losses of momentum may terminate the trend, and it becomes very powerful when the third divergence happens with the small triggers inside of the large. Odds favorable momentum has gone away, and now even your small chart has anything can happen triggers. It becomes more powerful still when the third divergence is higher than the second. This is a head and shoulders pattern, or if it's lower than the second, again, a head and shoulders pattern. It means that not only could price not reach or exceed the previous price, but they also stole momentum for the third time. And you'll see this on a smaller, faster chart when your larger chart can't give you that information fast enough because the large chart's slow. The large chart is a broad stroke of a brush. And if we go back to that one picture that I showed you, one bar on the large chart, these are all the bars within that one bar. So there's 1, 2, 3 cyan lines in the same price range. There's the market rocketing off to the moon. So patterns on the small chart will help you identify the large chart, guys. 3 divergences can keep you out of that next trade, keep you from taking that loss on the short, that loss on the long. 3 divergences can also tell you if you took the perfect short, well, it may be time to collect profits, to get out, to wait for the next best. So you're going to use the small chart. The only termination will be 3 divergences. The only time we're going to give lines any credit on a small chart is when we're looking for entries. So don't let a blue line on a small chart scare you out of the perfect trade. The only termination condition on a small chart is 3 divergences in the same location. Large chart said strength, gave us momentum. Large chart said termination conditions are false, gave us a clear path. We can see it on the most current bar. And I want to make sure everybody's with me here. The background is green, therefore the market is going up. We're only looking for rules to be met per high probability trend trades long. Guys, this will keep you out of 50 to 60% of the losers that new users typically take. Never fight the large chart trend. Large chart has momentum. Small's above the large are wide, there's space between, the scissors are open. Rule number 1 is in place. Again, one of the most common reasons for loss for the new user is fighting that large chart momentum. There's just no reason to do it. And now the large chart says that we have a clear path. The most current bar has not reached Fibonacci resistance. Both triggers have already cleared resistance behind us. You can see that it's behaving as support. Give me a Y in the room if you see that your rules are met on the large chart. It's up, it's strong, and there's nothing in the way, guys. It's time to look for an entry. It's time to turn our attention to a smaller, faster chart. And on the smaller, faster chart, we're going to buy low. When the large chart says up with strength and nothing in the way, we're going to do it at Fibonacci support. If it were going the other direction, we were going to sell high. Guys, you've heard for your entire life, buy low, sell high. You now know where low and high are. You now have the advantage of pinpointing the perfect entry. One bar on the large chart is broken down into 15 to 30. It's this refinement that increases our profit potential. It's this refinement process that mitigates and reduces our risk. And guys, this one bar never changes. It is beautiful, start to finish. Everything says down, but your small chart is gonna come back. Your small chart's gonna get triggers against it. Your small chart ideally is gonna pull directly back to resistance inside of favorable large triggers. So I'm gonna go to the spreadsheet, the same one that I dropped in the room for you, the same one that I'm about to drop in the room for you again. In the upper left-hand corner of the third tab, entry sequence short, entry sequence long. And I want you guys to look at this. Everything begins with a large chart. Large chart says down, large chart strong, large chart clear path. So we are going to, on the smaller, faster chart, let's talk out the rule real quick. We're going to use a limit order, meaning that you're literally going to wait for the market to come back to you at the point of entry. You're going to use a limit order, and it's going to be at areas, fibs, midbands, yellow 1-to-1s. Remember, those are the same areas on a large chart that could say there's a problem. On a small chart, these are areas that are going to give us a bounce, hopefully, ideally. But we want those areas to be inside of triggers. We want them to be inside of what I call favorable large triggers. Your small chart actually has 2 large triggers on it. One of them is the large triggers native to the chart. It's going to help you identify momentum. The other one is just the large trigger from the large chart. We call it the synthetic trigger. When the large trigger and the synthetic trigger are one on top of the other, when the large trigger and the synthetic trigger are trending strong in the direction of the trend, when the large trigger and the synthetic trigger give you that best of the best look, we call it favorable large triggers. So for the brand new user, our rule is going to be to buy or sell a pullback at an area inside of favorable large triggers. The triggers behave as a correction point, moving average, right? And the market loves to correct back to triggers. But what we want to do to give us the best chance of success is give the market something to bounce off of. I want you to picture in your head that you're throwing a tennis ball directly into a wall. And that wall is what creates the bounce inside of the triggers. So when we talk about rule number 3, where on earth was I? We're going to let it start on the large chart. And then on the small chart, we're going to wait for a reversal bar. And that reversal bar signifies the beginning of a pullback. Once I get the reversal bar, I'm going to identify my triggers, my synthetic and my large, because I know that price is likely to correct to them. Notice that the reversal bar already hits the large triggers. We don't trade the high probability trend trade from the large triggers. We are looking for areas within the large triggers. Price corrects to the large triggers, the regression of the mean, I believe it's called, and then we give it a place to bounce off of. Resistance inside of favorable large triggers. It can be red Fibonacci, it can be magenta midbands, it can be yellow one-to-ones, but you're creating what's called a window of opportunity, and your window of opportunity extends from the lowest point of resistance, this red fib, to the highest point of resistance, this midband, inside of favorable large triggers. And you'll notice that inside is all caps. This fib is outside of the triggers. It's beyond your correction point. This is not a part of your window of opportunity. So you're going to wait for the reversal bar. And at the time of the reversal bar, know where your triggers are. That's where the market's likely to correct to. And then identify the areas within. Guys, this is where the market is most likely to continue. And this is where you're going to activate a limit order. This yellow line represents the limit order. That just below the lowest point of resistance inside of favorable large triggers. Because remember, your large chart is screaming to the downside, and your large chart has nothing to bounce off of. So we're not expecting it to get high, but we know that it could. That's why we have a window. But we're not going to trip over pennies, guys. We're not going to stumble over a couple Lincolns trying to save a couple Benjamins. So limit order goes just below the lowest point of resistance, and if the market comes back, if they're able to push to your limit order, you're in the market. You're in a short trade, but you're in a short trade with odds favorable momentum on the large chart. You're in a short trade with absolutely no termination conditions, nothing in the way on the large chart, and you have just entered the market where it is most likely to continue the trend at the best of the best area inside of favorable large triggers. And guys, this is the one that typically wins 70 to 80% of the time. This is the trade that creates a boatload of confidence with the memory of success. And this is your entry. For the first 20 days, guys, all I want you to do is be able to draw that cyan box. I want you to wait for pullbacks when the rules are met. I want you to look at your trigger lines. There's your red box, and remind yourself, my trades don't come from the trigger lines. My trade comes from the area inside of favorable large triggers. So my window of opportunity extends from the highest point, this midband, to the lowest point, these yellow one-to-ones. But the large chart is screaming to the upside, so your limit order is placed just above the highest point of support. Guys, this is your entry. This is the best of the best. This is the one that creates manageable trades. When the market's going down, it's the same darn thing. Wait for the reversal bar. Identify your triggers, the red box, identify the areas within. In this case, there is one midband. How easy is that? Limit order goes a couple ticks below it. I want you guys to notice the small triggers turned against you. That's okay. They have to get you to the best spot. Divergence print. That's okay. 3 divergences kill it on a small chart, not 2. Guys, once you figure out how to get in at the right spot, it becomes very, very manageable. Large chart says momentum, large chart screaming to the upside, large chart hasn't reached the treble, but it sure is close. By waiting for the small chart reversal bar, identifying support inside of favorable large triggers, we've turned $50 worth of potential profit into $250 worth of potential profit. Notice that the tail on the large chart gets circled and the circle lines up with support inside of favorable large triggers. I told you guys we wouldn't be trading tails. We would be able to pinpoint exactly where the tail is most likely to continue. And I want you guys to use this because this is going to be your study tool. Guys, this is how you are going to, with aggression and anger in your heart, prove me wrong. You're going to say, you know what? Mark's full of beans. There's absolutely no way. When there's odds favorable momentum, there is no way when everything says down that I'm going to be able to pinpoint where the market is most likely to continue. It just does. Oh, okay, so maybe it does happen. Maybe you can go back and study it. Maybe you can look at it. You can say to yourself, hey, I can do this because I know exactly where the market's most likely to continue. And you can go back and you can circle these tails. Sometimes they have a clear path. Sometimes they only have the potential to break, But the pattern that you'll recognize over and over and over, where is that circle? Is that the market loves to pull back to areas of support inside of favorable large triggers. Rob, it really is unbelievable. I don't disagree with you at all. I'm still floored all the time when I watch this work. My brother still says, I can't believe it. It's incredible. And he wrote the software. So what we're doing is we're going back and we're just circling tails and we're seeing where it happens. And we're developing trust in the idea that when we speak to ourselves in terms of advantages, we can begin to take advantage. And that's all that we're doing, guys, is we're saying to ourselves with a ton of momentum, when everything says down, I've got a better chance when I trade with the trend rather than against the trend. I have a better chance when I trade with momentum rather against momentum. I have a better chance when I don't trade directly into termination conditions, because this is an area where decisions are being made. This is an area that may stop the market. And you'll notice that the area breaks and it pulls right back to it as resistance, and they continue to move down to Fibonacci support. None of the triggers broke through. Now I have weak triggers. There's 3 divergences. Holy crap, every rule that we just talked about coming into play. No short trades, ladies and gentlemen. Your rules aren't met unless you've decided to break your rules, in which case that's on you. But this pattern happens, guys. It happens on every market. Whether it is crude oil, whether it's the NASDAQ, whether it is the S&P, whether it's the Russell, you need to define where the market is most likely to continue, because once you do that, you know where the market shouldn't go. Once you're comfortable and capable creating a window of opportunity, you have just allowed yourself the luxury of knowing where the market shouldn't go. You've just reduced your risk on every trade that you take. And this is an important one. So VM Tech, I know that you're going to watch this one later, and this lesson is for you. The first thing that has to happen, guys, is the large chart has to say strong triggers. This is the first start of your advantage. The second thing for the brand new user is making sure that you're not trading into areas likely to stop the market, that you have room to get to where you want to go. This leads everything. The large chart leads everything. If you take small chart entries when the large chart rules aren't true, you are more likely to get run over than not. And once you have the advantages here, waiting for the pullback lets you know where the market is likely to continue. And because of this, VM Tech, I hope you're catching this, your risk can be $100, not $1,000. Your risk can be $80, not $1,000. You don't have to sit and hope that the market does what you want it to do, because you've defined exactly where the market is likely to continue, and your protective stop will go 4 to 5 ticks above it. 4 to 5 ticks above the top of the window of opportunity. Guys, my average losers are twice as small as my average winners. Yesterday, I won 44% of my trades. I hit my goal plus an extra $300. Because I know where the market's likely to continue, I know where it shouldn't go, and that's where my stop goes, long or short. And then once you get a reversal bar in the direction of your trade, you're going to reduce it even further, a couple ticks above it, a couple ticks below it. And what you're going to find is that anything that wins 70 to 80% of the time, it will lose. Guys, I will never tell you that you won't take losing trades. But what I will tell you is that you don't have to lose huge. When market pulls back to support inside of favorable large triggers and gives you a reversal bar, your stop is probably $30, $40 worth of risk at this point. And the market comes right back down. Take that loser, accept that loser, know that you had the advantages, and be okay with the idea that you can't win every trade. But if you're going to die in a trade, if you're going to take a loss, doesn't it make sense to be sure that you had momentum, a clear path, and an entry area, that you gave yourself the best chance of success as a brand new user? I think that it does. Be okay with the losses, guys. They're going to happen. Embrace them. It's part of the learning curve. The more you take, the more you'll learn, I promise. Look at this. Weak triggers at resistance. None of them break through. Ooh, let me get that cursor off of there and get to, there it is. We only had two divergences, but termination conditions were true. And now momentum is strong. Guys, check it out. Odds favorable momentum. Both triggers are below the fib, haven't reached any other areas. My lowest point of resistance inside of favorable large triggers happens to be yellow 1-to-1s. And they're close. I lost my pointer. But I want you to see something else on this trade. I've also got resistance inside of these triggers. So which one is it going to be? Is it going to be the low one or the high one? If I get into the low one, don't I have to put my stop above the high one? I want you guys to see how these split triggers create additional risk. Because you don't know which correction point it's going to, it becomes more difficult to make the decision. Price reaches Fibonacci support, absolutely no triggers break. It bounces all the way to Fibonacci resistance. Nothing happened. Oh, no worries. Adriana, show me your trades and let's take a look at them and we can show these guys what we're going to do with every trade. Weak triggers at Fibonacci support. There's another one of those lessons. Notice that the smalls are above the large. Drop them in, Adriana. We'll talk about every one of them. But we never got momentum up, and I'll be darned, the market pushed down. And then to the next fib, weak triggers, and we start the process over. So Adriana, divergent, pivot, stop out, couldn't reach second target. Where is your pivot stop out, Adriana? There was the potential for one here, but everything broke. So what you've done is you've taken a momentum style trade. You have odds favorable momentum. You let the area break and you buy the pullback to it. This is a momentum style trade. And then when you get to the first trouble spot, you take some money. Your stop is perfect. And your exit is beautiful. I love it. This is how you take the trade. And Adriana, one thing that you could even do to get a little more out of these trades is if it's momentum that gets you in, I'll trail behind a reversal bar. Because a reversal bar on the wrong side of the small triggers is certainly a loss of that immediate momentum. And that's where I anticipate the pullback to the area inside of favorable large triggers. So just a way to get a little more out, but it's a beautiful trade. It's a momentum style trade. And you'll notice that it was 3 divergences. You'll notice that you got a full roll. You got odds favorable momentum. You let it break and it pulled back. Adriana, I'm not sure you could have done that any better. And then this is just a trend trade. Odds favorable. It's a 50-50 on the divergence high. You take the perfect entry, you get out of the trouble spot, and you're waiting for it at the fib. And the second trade lost, the second contract lost, and then Adriana, termination, that's a strong bottom, right? I want to make sure that you get this tool. This is a strong bottom. This was a termination that created the reversal, that gave you the odds favorable. Are you good with that? Do you see how your path isn't clear, that this is that 50-50 look on the divergence high? It means that the area has the potential to break, but it hasn't broken, right? Are you comfortable with that? This is the part that lets you know how you need to manage the trade. So there's 3 looks for termination conditions, Adriana. Price reaches the area and no triggers break. That's a termination condition. Are you good with that one? This means no long trades, essentially, for the new user. Smalls and the large get above the area. Now the area is broken. The path is clear. This is the best of the best for the new user. Are you good with that lesson, that when both triggers get above an area, the area is considered broken? Cool. So when your small triggers get above a line, and let's go back and define what the lines are, because this is where new users do themselves a disservice. You have to know that when both triggers are not above support, resistance, 1-to-1s, divergence highs, divergence lows, that area isn't a clear path. Your small triggers are above the divergence high. Your large triggers have not broken. So Adriana, what you're getting into here is what we call a 50-50 trade, which is not a high probability trend trade. The area has the potential to break with odds favorable momentum, but it's not broken. So not a clear path. And what that means for us, and the most important thing that means for us, is that we're no longer in the high probability trend trade range. So what we've gotten into is what we call a medium probability trend trade. So I'm going to piece it all together for you here. This is a great picture. We just took clear path out of the equation. Do you see how that happened with your picture? It's not a clear path because it's a 50-50. Let me know that you're with me so far. This is the most lost trade by new users. So if I don't have a clear path because it's not broken, it's imperative that I have momentum. It's imperative that I have an entry area. So Adriana, the most basic plan says divergence is a loss of momentum. So if divergence prints on a 50-50 trade, no more trades. That's the most basic form. But here's the reality of becoming a chart reader, is this strong bottom, this termination that reverses everything, key area is not reached, increases the likelihood of this 50-50 working. So what happens is you may say to yourself, this one divergence won't keep me out because of the strong bottom. Your entry is perfect and your risk is virtually nothing. But because the area is not broken, one of the things that you can do for yourself is take profits at the first trouble spot, which you did beautifully. Are you with me so far, Adriana? We're talking through the whole process here. And because the area isn't broken yet, because you've already had one divergence, I want you to go into the mindset. You have to manage this trade differently. We don't hope for home runs on medium probability trades. You have to have it in place. If a second divergence prints, I'll exit. That's it. If a second divergence prints, 2 losses of momentum without a clear path, there's no way in hell I'm staying in this trade. So what that means for you is this 24 stop is now about a 30 stop, which is $120 worth of profit locked in. Because by the third bar, 2 bars below that reversal bar marker, you'll know if divergence is true. And if it is, GTFO. Does that make sense? So you have to know what kind of trade you're getting into. High probability trend trades, with everything in favor, with everything screaming, 2 divergences doesn't worry me. But if it's a medium probability trend trade, divergence is a loss of momentum. Does that make sense to everybody in the room? Divergence is a loss of momentum. And then you're just relying on an entry area. And guys, there is probably no trading plans in the world that tell you, go ahead, give up 66% of your advantages and hope, pray, wish, want, right? So guys, knowing what kind of trade you're getting into, the second it's not a high probability trend trade, we can still take it, but we have to manage aggressively. But if it progresses to giving up 2/3 of my advantages, no freaking way. That's where, Adriana, you could have been out at 29 and not given it all back, right? And because you already took beautiful profits. You already took $200. That's a $320 trade. instead of letting the other one come back to break even. Does that make sense, Adriana? It's a beautiful trade. It's a beautiful entry. But guys, you have to know what kind of trade you're getting into so you know how to manage it. And here we have weaker triggers, clear path. Hey, Miss Cindy, happy Monday. And an entry area. Adriana, are you still with me? You didn't run to work yet, did you? Let me take a picture of your picture. So I want you to see this one. You have a clear path. Can we agree? Small and larger above the area, the path is clear. You do have an area for entry inside of favorable large triggers. Rule number 3, rule number 2. Do you notice that you don't have odds favorable momentum? So let's use the little slide ruler again. It's not a high probability trend trade. And Adriana, it's a beautiful trade, but you've already had one loss of momentum. You've identified the trouble spot, and you lost break even. So once again, because it's a medium probability trade, because you forfeited one of your advantages, maybe a pivot stop out takes you out, right? You're not willing to risk it. 2 ticks below the reversal bar marker. If I get a pivot stop out with weak triggers, it's probably going to drop lower. Does that make sense? So guys, I want you to build one of these. Is it perfect? Is 1 missing? Is 2 missing? Am I just hoping? And this little trick, guys, build it on your desktop. Like print this out and make a little box. And ask yourself what you're getting into each and every trade. Adriana, great trading though. Nice entries, beautiful work. You're doing just fine. I'll see you tomorrow. And how are you going to know what kind of trade you're getting into, right? Well, you're going to know in terms of advantages. I know you're not. I know you're not. I'm not worried about you. You're going to excel. You are excelling. Guys, you have to know what you're getting into so you know how to manage it. You have to know whether your advantages are in place or they're not. You have to understand if you're giving something up or if everything is perfect. And the easiest way to do that is to have a plan, to have a written plan. I had a gentleman, most of you have probably been amazed by his consistency in the other room, but he told me once, he said, Mark, if you don't have a written plan, then you don't have a plan. And most of us are smart, right? We're super smart, intelligent. People want to be us because we're kind of a big deal. And we're like, well, I know my plan. I know my plan. I know in my head what my plan is. And guys, this is where your brain opens doors that don't exist. This is where you create loopholes. This is where you break rules. If you don't know exactly what it takes to get into a trade, then how do you know if you're breaking your rules? If your rules aren't clearly defined, then you leave yourself open to break them, to trade opinion. So I'm going to give you a plan, brand new users, and this plan is the KISS plan, the Keep It Simple Sunshine plan. And it's a stepping stone in your learning journey. I don't want any of you to be shackled to the high probability trend trade for the rest of your life, but I want you to focus on it for the first 30 days that you're with me so that you can become a chart reader. And this plan is designed to optimize your chances of success on the high probability trend trade and that 50-50 trade that we just discussed. And through simulation, study, class feedback, and continuous practice, guys, you're going to create your plan. You're going to create a plan that suits your needs, that suits your goals, that reflects your ability to read the charts. And it's all based on your experience reading the indicators. So the more pictures you take, the more you ask for feedback, the more times you post in the room and you hear the same thing over and over, you're going to create your plan. But the simple plan for consistency, it begins with never fighting the large chart. Don't fight the large chart direction, guys. Don't fight the large chart triggers. Don't trade in determination conditions. Just don't fight. You are a one-finned guppy in a pool of sharks. So let the sharks do the work. And this is a little tongue-in-cheek, guys, but this is how you commit financial suicide. Trade into termination conditions, trade against strong triggers, and you're pretty much destined to lose money. Just even fighting the trend. I haven't told this story in a while. I'm going to share a pretty funny story. My brother had a friend that was a broker years ago. And the broker calls up John and he's messing with him. And he goes, "Hey, John, man, I finally figured out how to guarantee you $1 million in your trading account." And of course, my brother likes to make money. And he goes, "Yeah, that sounds awesome. Tell me what you got, man." And he goes, "Okay, so I finally figured out the recipe." He goes, "I want you to go ahead and fund an account with $3 million. And then I want you to fight the trend and I want you to fight the momentum and I want you to trade into areas. And by the end of it, you should be down to $1 million." And they had a good laugh. But it's a pretty good story. And it's a funny story that reminds you that we're not in charge. Go with the flow. And define your entry. Get into the market where it's most likely to continue because it reduces risks, because it increases profit potential. And I'm going to give you guys a checklist. I'm dropping it in the room right now. This is your trend trade checklist, guys. Print this out, put it on your desktop. Police yourself. Every time you take a trade, did you have the advantages? Are you speaking to yourself in terms of advantages? I've never had anybody mark yes on every one of these and do worse than 70% ever in the history of it. And I've had people put it through automated simulators with the rules written in, and they end up around 83, 90% over 400 or 500 trades. For those of you that are visual and just trying to get it, here's the same checklist, but it shows you exactly what a strong bottom looks like, a termination that creates a full reversal. It identifies momentum, odds favorable, and it reminds you, hey, that's anything can happen. Stop wasting your money. It defines termination conditions. So guys, this would be great if you're not getting the 50-50 thing yet. There it is. Potential to break, but not a clear path. And then it defines your window of opportunity. So I'm going to give you guys this one as well, because this is the path to getting you proficient on entering the market with advantages. And there's pictures in the KISS plan here so that you can go through and look at what strong bottoms, what strong tops, what strong triggers, terms at lows, terms at highs, entries longs, entries shorts. Guys, I'm giving you everything that you need to be successful. It's up to you whether or not you're going to use it. And then once you define your entries, you have to do something with it. That's management. You're already managing your risk through strong triggers. You're already managing your risk through no termination conditions. You're doing a bang-up job of managing your risk by entering where the market is most likely to continue and having a solid stop plan, putting the stop where the market doesn't go. And then there's that magic phrase again. You will craft a plan tailored to your personal goals based on your experience reading the indicators. So every picture that you put in the room. So Grant, termination, odds favorable, late entry, right? We could have reduced risk and maximized profits. And then with all this momentum and absolutely nothing in the way, why not grab hold of it at the trouble spot? So your entry gets feedback. You're in at 64, which means you're in all the way down here, Grant. You gave up all of that because you didn't trust your entry. And that's okay. It takes some time. But with no divergence, with strong triggers, with a pullback to resistance inside of favorable large triggers, you could have been in at 65.8. Your risk could have been drastically lower. And then with all that momentum, the likelihood of it going to the target, it jumped down on you. All right, but Grant, can't we agree that with a strong top, with odds favorable, the potential to break, no divergence, couldn't you have just been waiting with a limit order rather than trying to hit sell and time it out? So guys, this is what we do in the second hour and the third hour. Grant, this trade is 32 flavors of kick-ass. I love this trade. But now Grant's going to say, man, I could have sold on the way up. I could have reduced my risk. And then with all this momentum, Grant, did it make it to 63 flat in that move? Did it make? Of course it did. Look at the momentum. So in one picture, I can say Grant's knowledge of strong tops and bottoms is spot on. I can say Grant's ability to recognize momentum is nothing short of perfect. But Grant, we have to take pictures and develop trust so that we can reduce risk and maximize profit potential. So I know without a doubt that Grant doesn't fully trust rule number 3, or he would have been in on this side, not this side. Totally cool, Grant. Still a great trade. And why did it jump? And that's what I want to cover. Why did it jump, Grant? Because there was somebody with deep freaking pockets that said if any asshole tries to push against my downtrend with all that momentum, I know exactly where I'm going to shove back 10 times harder. The cool thing is so did you. You just didn't trust it yet. Does that make sense? You knew exactly where it was going to happen. You just don't trust it yet. That's okay. That comes in time. But you have to go back and you have to re-annotate this chart and you have to put your confirmation. And so, okay, I get that. You want confirmation, right? So what is confirmation to you? Is that a reversal bar? And I'm just curious because my confirmation is a strong top, odds favorable, no divergence, perfect window. That gives me everything I need. 2 or 3 bars after hitting the line. Okay. So Grant, your plan has you in exactly where you want to be. My plan gives me an extra $200 and it reduces my risk by $200. My plan has been put in place over 27 years. My plan is repeatable. It's something you can study. My plan has very concrete rules for when it's okay to get in. My plan may be a great study point for you. Rather than waiting for confirmation, go back and let's do this. Guys, we're building trust right now. Rather than waiting for the confirmation, the opposite side is you can just wait for the rules to be true and go circle those tails and Grant, see how many times you could have added $200 to your account. You have a lot more risk, my friend. You have exponentially more risk. I would rather take a small loser. Because what have you done? The only thing that you've done, Grant, is if it goes down 5 bars and bounces up, is your risk is huge. If it goes down 3 or 4 bars and you finally get in, you've robbed yourself of $100 every time. Imagine that. 5 trades a week, extra 500, extra $2,000 a month, extra $24,000 a year by learning to trust the best of the best entries. And that's kind of what we're going after here. Is that's the feedback that you guys will get in class, but you have to know what you're looking for first, and you have to trust it and know what it is that it takes to get you in. Guys, my dog is going ape shit. I am going to take a moment. You guys watch this termination condition. See if it holds. I'll be back in 5 minutes, and then we're going to finish up the management side of the KISS plan. Hey! All right, guys, I'm back. We are going to keep going. I feel like we had a little momentum there. But back to the KISS plan. The entry for this one, guys, this is the one that typically wins 70 to 80% of the time. This is the trade that really is designed to keep confidence, and each and every one of you are going to have your own way that it feels good, that you have warm and fuzzy. So, Grant, there's nothing wrong with waiting for confirmation at all. Um, Something that you may consider is rather than waiting for 3 or 4 bars off the line, because by then it's gone, right? One reversal bar establishes your risk, doesn't it? Just per the rules. One reversal bar says, hey, Grant, we're going in the direction of momentum. We're going in the direction of the clear path. And now your stop goes right above it. So if it does go to the top, you don't have to sit through that. But if it starts to go down, you could actually have, whoops. And I love to do this. Sorry, my Ninja Trader, it hates it when I take breaks. I've been drawing on it too much. What happens is you can put a stop order right at the reversal bar marker, and you can say, all right, when all the conditions are great and I feel good about it and I know what I'm looking for, but I don't want to get in on this side. And that's okay. There's people that do that all the time. What you can do is have that reversal bar marker, have that stop order waiting for it. And what it does for you is it says, okay, if it starts to go in the direction of all the things that are telling me to go short, well, then I'll enter on the reversal bar marker, because what that does for me as a trader is it begins to build confidence in the idea that now it's doing what it's supposed to do. It gives me the ability to already have my risk established. And maybe that's a great first step in confirmation. And I feel comfortable saying that eventually with this look, you'll start going, man, there's trades where I need to wait on confirmation and there's trades where I don't. And you'll learn what works best for you. And I'm not trying to change your trading plan at all, but one of the things that we do every time we look at a chart is we talk about the advantages, we talk about the entries, whether or not there was a lower risk, higher profit entry. And then eventually, I guess what I was getting to with that one is you'll begin to recognize when you can hold for longer moves. When your large chart tells you, hey, let's get an extra 50 bucks out of this one. Let's get an extra 100 bucks out of this one because we've got the best momentum and nothing in the way. So great entries create the most manageable trades without a doubt. And every entry for the brand new user focuses on getting in where the market is most likely to continue, because then you know where it shouldn't go, and that's where your initial stop goes. You will take losers. It will hurt your feelings. So when you take a loser, make sure that you're taking a loser with all the advantages. Make sure that if you take 10 of those trades, it's more likely to win 70 to 80% of the time. And one of the things that everybody forgets is if you take 100 trades, and guys, that's going to take you a week or two maybe, you're going to lose 20 to 30 of them. So the better you manage your risk, the lower your risk is, the easier it is to get the most out of those trades. So once you're in, you know where the stop goes, and if it hits it, you're out, normal part of a positive equity curve. But if it gives you a reversal bar in the direction of the trade, well, now it's doing everything that you want it to do. Remember, you're in because of odds favorable. You're in because of a clear path. So you're going to reduce risk 2 ticks above the reversal bar. And guys, there's nothing to do at this point. You're either going to get stopped out or you're not. And again, small losses, right? It's amazing when a trade doesn't work and you only lose 20 or $30. You're like, I spent that at McDonald's yesterday. No worries. And with all that momentum and a clear path, very little risk, it's more likely with the rules met to hit that $100 than it's not. And your first target's 100 bucks, guys. That's only 8 ticks on the S&P, 10 ticks on crude oil. And what this does for you is you hear Ninja Trader tell you profit target reached, and you see your account go up, and it feels good, guys. It's confidence, and it's not a big target, but $100 a day on a 2 lot. If that's the best you ever pulled off was $200 a day in the market, that's still almost a $50,000 year. which isn't a bad little supplement, I think. So once you hit your first target, you're going to go break even. You're going to get rid of all the risk. So not only did you get paid, you've got nothing to lose. And then with nothing to lose, it makes it easier to trust the large chart. It makes it easier to believe that when the large chart has this much momentum and nothing in the way, that it's likely to get to that next key area. And that's where you begin to hold for these bigger moves. That's where you don't put your stops 2 ticks behind because you're just chumming the markets. That's where you really start to get to that next level. That's where you start turning smaller trades into bigger trades. And if this one goes to the next target, it was only $200 off in the distance. And guys, that's a $300 trade. And again, if that's the best you can do is $150 per contract every day for the rest of your life, you've added 72 grand a year to your pocketbook, which is a pretty good feeling. So the idea, and what I'm trying to stress here, is that before you try to be a trader, try to be a chart reader. Learn how to read your indicators. Learn how to understand the advantages that they're providing. Learn how to enter the market at the best of the best spot. And each trade will have a different management approach. So it's important that you know what you're getting into. If it's high probability, man, it's hard to get me out of a high probability trade when the large chart's perfect. If it's a medium probability, one of those 50-50 trades, well, then you have to take things into consideration like divergence that may ruin that trade, like it coming from a termination condition without question, or it's less likely to work. And guys, management takes chart reading. Understanding what kind of trade you're in takes chart reading. So keeping it simple first, get good at it, and then add the 50-50. And I can tell you right now, the 50-50 is the most lost trade posted in this room. And 99% of the losers revolve around divergence. So as you add the 50-50, guys, make sure that you're aware of your small chart divergences. There's your KISS plan in the room one more time. And that's the first hour. Are there any questions about the high probability trend trade? Guys, are there any questions, anything that I can clear up for you regarding momentum, regarding direction, regarding terminations? Is everybody comfortable with the concepts? I want you to begin speaking to yourself in terms of advantages. I want you to look at your chart and not say, is this a long trade? Not say, is this a short trade? I want you to look at your chart and say, do I have momentum? Do I have a clear path? And if so, do I have an entry area? Because one of the biggest advantages that you can give yourself, I'm going to open up a brand new Word document, and I'm going to give you the most simple form to success. Because guys, there's 2 options. Either your rules are met or your rules are not met. And there's only one of those that should result in a trade. So you have to know your rules. And your rules provide advantages. So you have to talk to yourself in terms of advantages. No matter what type of trade you take, that is the path to getting to where you want to be. So Mario, I can. But I'm gonna come back at you for what kind of trade? For a high probability trend trade, for a momentum trade, for an HVA trade. The idea with the high probability trend trade is that you first have to be able to define where the market is likely to continue. And if you can't define that point, well, then stops become difficult. Show me a picture of your momentum trade, Mario. And then we'll talk about where the market shouldn't go. But that's your answer every time. Where the market shouldn't go. But there's too many different looks on a momentum trade. I don't know what your rules are. Are you entering only on the momentum phase side of the triggers? Are you entering on a snapback to a Fibonacci area? Are you entering when 1-to-1s break and then pull back? Are you taking a mid band right at the small triggers? Are you just jumping in? So without actually knowing what your entry looks like, it's difficult to understand where to manage And it's even more difficult for me to give you a definitive answer on management. And I'm sorry. That's where, guys, this is where it's so important that you guys show me pictures. For example, this is a momentum trade, but I don't know if that's your momentum trade. This is a second higher divergence. This is screaming on the correct side of the small triggers, allowing the area to break and then pull back to it. So Mario, this is one style of utilizing momentum to your advantage. Where does your stop go? Where do you expect the market to hold? I expect this blue fib to hold, which means that I might be willing to risk 2 or 3 ticks below, I don't know. You can wait for it to start to go up and put your risk below it. You can catch it on the way in which case you would need a different chart to tell you where the next down bar is, or you'd have to put your stop maybe where the next down bar is. I use a range chart, and I'll show you how I use it, and John uses this. So for that particular momentum trade, Mario, when I got this down bar, I would have bought Fibonacci support, and my stop would have gone where this bar becomes a second down bar. And then once it goes up, my stop is right behind it. So if you're using a range chart, that's the easiest way to do it. But not everybody uses a range chart. So if you're not using a range chart, you have to say to yourself, okay, with this momentum, with this look, with this pullback and no divergence, I'm willing to give this trade XYZ. I'm willing to give it 5 ticks below support. I'm willing to give it 7 ticks below support. I'm willing to give it 25 ticks below support. Or because it's not a high probability trend trade, because I'm only relying on momentum, well, maybe I just don't even enter it until I get back to the correct side of the triggers. And then I go below the reversal bar. And then I exit with a close on the wrong side of the triggers. Does that make sense, Mario? Yeah? Okay, cool. And this is one of the great things that you guys can do is post some trades in the room. And then we'll talk about it, right? We'll talk about what's going on your chart. Show me times when you've got stopped out. But I'll tell you right now from experience, I see people trying momentum trades from over here, from the wrong side of momentum. And that's one of the biggest problems that I've ever seen, is trying to get into a momentum style trade from the wrong side of the small triggers. And being just a little bit early. All right, guys. So we're going to go through and I'm going to start clicking on pictures that you guys have posted. And we're going to start talking about what you guys see, what you've done, what you're talking about, what I can help you with. And I believe Lyle got us started today. Nope, we have Grant. So Grant, we got you fixed. Guys, if you ever get one of these hanging orange orders, that's the fix. So if you scroll up, you can get that picture. I'll drop it in the room real quick. But if you're on a live account, if you're on Trade-Evade or Apex or something like that, guys, you should always have your account up. Like this should always be up for you, so that you can come through and you can close your account if you need to. And you can close it from the Trade-Evade dashboard. You can close it from the Rhythmic dashboard. So give yourself that safeguard if things ever hang. And then Gary set us up with the perfect HVA trade, guys. And this is a second trade that a lot of you will learn, or the third trade, really. And it revolves around termination conditions. It revolves around the idea that when no triggers break through a Fibonacci support, Fibonacci resistance, that this termination condition sets you up for an opportunity to be one of the first ones in before the first trend trade. So Gary took this one absolutely beautiful. He let the termination happen. He let his triggers roll on his smaller chart, and he just bought an HVA line, which is the perfect trade. This is the first shot at going long from a termination condition, and then it ultimately sets up into trend trades. So this is a good one. But going long, 754, going long into resistance with all the triggers down is a good way to lose your money. Oh, that was a short. Going short, wrong side of stuff. So make sure you guys are showing everything. Don't just show me your winners. Show me your losers too. There's a lot of great information in losers, guys. All right, Roku, let's see what you did, my friend. I bet you it's a momentum style trade. Holy smokes. All right, so you came in at 81.35. Good top, not a good top. Odds favorable momentum, not yet. Midline indicating momentum, I don't know what that means. Background red on both charts. All right, Roku, are you with me in here? Let's go through a couple different things. Not a good top because it's coming from the middle of nowhere. Terminations are zero trigger through reversals. So what this is a bad top. Two divergences, weak triggers say we may go a little deeper, and that's exactly what happens. But being in at 81.35 means that you probably traded directly into a fib with all the triggers above it. Does that make sense? The smalls started to roll, but every trigger was above 81.35. So you're shorting directly into a termination condition, essentially. But you do have that immediate momentum on the small chart. So the easiest way to do this one is to let it break and pull back. And maybe you did. Maybe there's a little pullback there. Did you get in on a little pullback, Roku? A little snapback maybe. But until those small triggers get below, it's a little lower probability. And then it comes down and it pulls back again, right at the mid band. Small triggers. This is your higher probability entry. And then there's your loss of momentum. And there is you trying to make a decision on split triggers to get down. So, and because of the momentum, you stayed in. And that was a great read. And you're just taking advantage of the move down to support with all the momentum. And guys, one of the things that makes this trade successful, and this is, Roku, I don't know if you even talk to yourself in terms of this, but I do a lot, is if this is the small triggers on the large chart, in a downtrend, when the bars are to the left of it, this is what we call the momentum phase. This is the best look for momentum, immediate momentum. And then you have the exact same look on the small chart. You're in the momentum phase. Guys, it's hard to stop a market in the momentum phase. And Roku, you executed beautifully on this one. And even when it pulls back, you're still on the momentum phase over here, which means this is more likely to hold, which is what got you to the next target. Really great trading, Roku. Nicely done. It's not a high probability trend trade. It doesn't have to be to make money, but his ability to recognize what his indicators are telling him, it's okay. It's one of those things. If you call a duck a horse, but you still know that it quacks and tastes delicious, then it's fine. You're not in any danger of eating horses. I repeat it in class, and I talk about the termination or the terminology in class in the sense of consistency, right? In the spirit of making sure that it's the same lesson to everybody. But if you write something, somebody uses, I believe it's Bob, uses positive momentum to define strong triggers. I only had to see it 2 or 3 times, and now every time he puts positive momentum, I know that he means strong triggers. So I'll get to your terms, and I'll probably throw some synonyms out there. All right, Miss Jen. Support holds. I feel like you're missing fibs. You may not be. And then everything turns in the direction. 3 divergences supports the idea that the midband's likely to hold. You let it get above, pull back, and giddy up. I love everything about this trade, Jen. This is beautiful recognition of a termination, and the market's still going up, and all your triggers are up, and your momentum is the best. And you just say, hey, you know what? Small triggers through. Let's do a little snapback, giddy up. This is beautiful. Absolutely beautiful. And then Mario, hopefully he's still in here. I want you to see the pullback is to here, but it might go to the midband, right? So if I were going to manage this trade, my stop may need to be a little lower below that midband. Or as it starts to go up, I can put it below the reversal bar. And then there's another opportunity right there, a beautiful opportunity. Breaks, comes back, giddy up. And then, Jen, do you see how you didn't get a loss of momentum? Absolutely zero loss of momentum until all the way up here. This is a great time to learn how to hold a little bit. I actually love this trade. I'm going to show you a couple cool things here. That's your first shot. That's letting everything roll. That's beautiful. That's your second shot. That's your third shot. And that's your exit. Momentum in, momentum in, momentum in, and then finally the momentum dies. This is where, and Jen, this is hard to do. This is where my brother absolutely floors me, because he'll take this trade and he won't exit yet because nothing's changed. And I'll watch him put 2 more contracts on there, and he still won't exit because nothing has changed. And I'll watch him put 2 more on there, and then I'll watch him say, all right, that's probably it for now. I'll wait for the pullback. And where you and I make 150, 200 bucks, he's up $1,000. It's ridiculous. Yeah, but that's what we're looking forward to. Because in the moment you don't see it, you're so intent on following the trade that you're in that you miss out on the idea that there's more trades along the way. And you'll get to the point to where you see those. Everybody will. I watched my brother do it all morning this morning, and his rules and my rules aren't exactly the same. He's a little more gutsy than I am in cases, and he's a better chart reader than I am. But I began to see this, and I study it, and I take pictures, and I talk about the opportunities, and life is pretty easy. JW, I can't call this a strong top because my triggers got through. It's a great look. It's a great look. And if there were 3 divergences on the small chart, I could call this a little bit of overrun and then really call it a strong top. And then everything is down. The momentum is strong. Not quite a clear path where you get in. So what you're doing is you're really just relying on momentum here. And notice, JW, that you say entered the pullback inside of the large triggers, not at the area inside of the large triggers. And I think that language becomes important on this one, because if you're stop, it's a momentum trade, right? But you're getting in on the wrong side of momentum. See how this one right here, that's a rockin' momentum trade. That's an okay momentum trade. This is an entry on the wrong side of momentum. This is the one that more often than not either hits the midband or hits the area all the way up here. Did you catch the momentum phase lesson earlier? Momentum phase, wrong side of the momentum phase. So sometimes, and I'm not saying that you have to make your own decisions, is it really a momentum trade if it's not in the momentum phase? Or is it hoping that stuff continues down because I missed the first 2? And I don't think you trust it that much because you jumped ship when it got back to the momentum phase. It's a nice trade. It really is. I think the best trade was up here, and it makes it easier to manage. And trade to the mid band. Yeah, absolutely. 23.25 was a full point above your mid band. So somewhere you got cold feet. It's a good looking trade. But these are the trades where I keep momentum phase in mind, because I feel like if you're going to rely on the best momentum ever, you should commit to the best momentum ever. Knowing what you're in makes it easier for you to know how to manage it. All right, Grant, termination, full reversal, odds favorable, breaks the one-to-ones, pulls right back to it. Easy money. So where did you enter, Grant? Did you enter on the pullback to the one-to-ones? Or did you enter 4 bars up? Just curious. Because this may have something to do with where your mind's at, right? So curious, why at the one-to-ones and not 3 or 4 bars up with confirmation? Can you pinpoint what the difference is for you? And I'm not entirely sure what it is. I'm not going to lie. Why is this one cool at the area and that one needs confirmation? Is it the clear path? And I'm not trying to put you on the spot, but a lot of times when I see people take the same looks, good top, strong triggers, there has to be something in your brain that's a little different. There has to be something in your brain that makes this feel safe and this one doesn't. And if I can find that connection, then maybe we can get you to trust the trend trades. Maybe you just see momentum's easier. Because that's what this is. This is momentum. This is everything screaming from a good bottom. I love this entry. I love this entry. And maybe because this one was still 50-50, you're a little more cautious. I love both trades though. But this is one of the things where I try to figure out, why am I more comfortable with one trade than another? Like, I love this trade all day long. I actually probably might have been down a little lower. But if it were a 50-50, Grant, I probably would do the same thing. I wouldn't get in at this. I would wait for a deeper push. It's a beautiful trade. It is the perfect momentum trade. And then strong top, 3 divergences at the strong top. Oh, we already saw this one, right? You posted it twice. I don't know if you knew that you posted that one twice or not. It's a pretty close. I like the one-to-ones. No, it's okay. Guys, and I'm telling you right now, this is one of my favorite things about what we do is we all do it, is we all have things that we're comfortable with, things that we see very easily, and things that we have to process a little more. And Grant, your easy trade is the momentum trade, without a doubt. You absolutely crushed that trade. All right, Miss Jen. And I like this. This wasn't a strong bottom, but when it pulls back and retests support, it is, which makes the likelihood of it going up a little more. How did you pick your entry? So Jen, was your entry there at the trigger? Was it when it went back up? Because we never made areas. Was it the second bar? Was it the third bar? And I only ask for stop placement. I'm just curious. You let it break. I do like it, and it just never came back. And the momentum was outstanding. But these are the entries that I like to ask about because these are the entries where I'm going to look and see how consistent you are on your entries. Trigger was the first green bar. So after it tries to pull back but turns green, you get in at the top of that bar with all the momentum. Okay, cool. So let me, and guys, this is one of the beauties. There's a gentleman that trades in here that absolutely loves these trades. And I'm not saying that this is a next-gen rule or anything, but he'll wait for price to start getting above the tail end of the bar before. So you get those couple down bars, and then when price giddy ups above, you know you're looking for the trade. You'll see his entry right about there. And it's only a couple ticks, and then once it gives you that reversal bar, your stop's in place. But I thought this was a pretty neat trick. And I don't utilize it yet because I haven't studied it. I haven't gone through and practiced it, but that's something to think about, and it's pretty neat. Once he gets above there, he goes. Nice. And then when it pulls back to the mid band, you just add it on. I love it. And then why not get out at fibs? You're killing it, Jen. All right, Rob, let's see what we got, brother. So I assume this is not a trade to take. I see the pullback on the 13.1. When I look at the 13.2, but on the 5.1, it's not back into favorable large triggers. So no trade. So Rob, what you've just identified is a momentum style trade. You have a termination. Your small triggers are down strong. You're on the momentum side of them. You're on the momentum side of them here. It breaks the 1-to-1 and pulls right back to it. Rob, your chart reading's getting better because you're realizing this trade. And let me show you who else loves that trade. That's such a good look. Termination. The small triggers start to roll, pull back to the 1-to-1s. It's a momentum style trade. So it's not a trend trade. So the trend trade rules don't apply. So areas inside of favorable large triggers, that's not a part of it here. This is a completely different type of trade. And one that you're probably not taking yet. So you're absolutely right. It's not a high probability trend trade. But I feel comfortable saying that's a trade you'll be taking eventually. And then this is kind of the same thing. Pullback was to the yellow 1-to-1 inside of favorable large triggers. Would have been a good trade. Yellow 1-to-1s were at 83.50. Right there. Okay. Try to go along at the pullback. Didn't because you didn't have the ATM strategy set up. By the time you got it set up, it already pulled away. But you're saying that with this momentum growing, the area holds everything up. 83.50 provided you a perfect bounce point to continue up, probably at least to 89.50. Rob, it's beautiful. It's perfect. 100%. And then one more. Looks like a possible short. Smalls are on the right side, watching divergence on the 5-1. So right here, I want to make sure that I'm looking in the right spot. If divergence prints, that's your third. You'll choose not to take it. If divergence doesn't print, you're going to say area of resistance inside of favorable large triggers. I like the read. When I see these 50-50 looks, I manage them a little tighter, especially if there's already been two divergences. But what happened is the first one pushes you up, the second one pushes you up, and now everything is kind of rolling again. I love it, Rob. It's a great read. Are you feeling more comfortable? Because what you're showing me in the room right now is absolute gold. you're reading the large chart and then you're looking for entries on the small chart. You're gauging your momentum, and then the one thing that I would change, or at least consider changing, remember you don't have to, is change your language when you type on the chart. And I know that it's not always easy for you typing, but let's change looks like a possible short. Let's change that to strong top, because it's a termination that creates the reversal. Let's change it to odds favorable momentum. Let's change it to 50-50. And then what you do is you're saying, holy crap, this is beautiful. A 50-50 from a strong top is outstanding. That would have been a potential entry. There's my stop. And then, so you know why this has a better chance of working, because it was a strong top, because it is odds favorable, because everything agrees. And it keeps you focused on the rules, and it keeps you focused on the advantages. It's a great read. And that's just me being kind of nitpicky on the language, because as you really start to turn corners, it's important that you speak to yourself in terms of advantages, because what happens is your ability to read the charts gets your brain thinking that your opinion is better than your rules, and you see it a lot. It's okay though. And then Cav, everything clears, strong triggers, didn't trust the area inside, so you gave up a little bit on the pullback, but everything is perfect, and your exit is perfect as well. It's awesome. This is the one when the divergence prints, I'm 2 ticks above support. I'm saying because of the divergence, because it is still a 50-50 technically, that midband is a little higher probability, that fib. And it's not a huge difference. 66, 64, 2 points, $40. That's you saying it's worth the cost with that look. And I think you killed it. Nicely done. And so for those of you that are new, this is what we do. And you know what, Zorro? I think you posted, and I may have accidentally missed it. I'm going to scroll up real quick. And guys, if I ever miss a chart, please let me know. Did you delete it, Zorro, or did I miss it? Because I thought you posted one. Maybe you got cold feet. That happens sometimes. And I remember it because you posted 2 charts, and I got excited because you posted 2 charts. Maybe I missed it. Maybe you pulled it. Oh, tell Lowe's I said hello. They took some of my money this weekend. All right, Grant, let's see what you did. Strong triggers, clear path, everything says up. You get in beautifully. Areas inside of favorable large triggers. And man, a lot more money and a lot less risk. And Grant, I know that this came after our conversation. Did the conversation help? You're very welcome. And just, there's your old entry. Man, I love it. Beautiful, Grant. I really do. I get a little giddy, guys, when we get to have a conversation and then I see you put the application in place in the same day and make a lot more money with a lot less risk. And the cool thing is here, Grant, is even on the second pullback, if you're break even, you're still safe. And if you didn't catch this one, there's your second trend trade opportunity. Absolutely beautiful. Absolutely beautiful trading, Grant. And then Cavs talking to lows. And then once again, pull back inside of large triggers. I have to say, it's my duty to say that I don't have any rules. I don't teach any rules that take a pullback to the triggers. All of mine say take a pullback to an area inside of favorable large triggers. And when divergence prints, it's more likely to hit it than not. But everything's going down. It's just a momentum stab and then an exit with momentum. So good stuff. All right, guys. That's all the pictures, too. We made it through. I'm going to let you watch crude oil into the termination condition. And then when I come back, we'll get back into it. The delivery people are killing me today with my dog. I'll be back in about 5, guys. Hey, seriously, you are a great dog. You are a strong dog, a tough dog, and you are the best guard dog ever. There is nothing out there. There is nothing out there, which means you need to stay away from the front door. Come on. I'm going to put you in your crate, is what's going to happen. You understand that? I'm going to put you in your bed and bark because I can't teach my class if you're going nuts. So I need you on the barking down. You understand? I love you and you're such a great protector. And I need you to calm the barking down. I need you to stop barking. I have a class to teach. My class is that. You want to go to work? Do you want to go to work? Let's get a treat because you're a good girl. Let's get a treat because you are a good girl. You're just barking because there's mean things on the other side of the door. Dude, whoops, sorry. It's okay. You can still have it. It's still good. Awesome. I have to go back to work. All right, y'all. Let's get into that last hour. Andy, I'm assuming you have an issue. What is the white line? It looks like a line that you drew in. Did you notice? Okay, that's calculating, so you probably can't do anything yet. Andy, go up to the pencil and remove all drawing objects and see if that gets rid of that white line. It looks like it's just something that's been drawn in. All right. Let me know if that helps. All right, Cav, you're back. So I'm not sure if you caught this one. Love the momentum. Everything's up. The language a lot of the time, Cav, is pull back to the triggers, right? Pull back to the triggers, not the areas. They see it there. Pull back to the triggers. You say the same thing here. Pull back to the triggers. Totally cool. This one, when you already have one divergence, you have a second divergence. I don't know. I feel like, no, it's okay. Your language is accurate. But I always wonder why you pull back to the triggers. The triggers are like clouds. So the triggers are a potential correction point. Let me show you. I'll pull it up on a small chart. The triggers are a potential correction point. It's the areas within them that give it a place to bounce. Potential correction point. Potential correction point. And look, you don't know which one it's going to go to. Yeah, it may have, Andy. That happens sometimes. So while I love the idea, this is a pullback into the triggers, right? But it's the mid-band that creates the bounce. This is a pullback into the triggers, but it's the mid-band inside of the triggers that creates the bounce. No, Cav, I didn't say that at all. You completely missed my point. That's okay. I'm going to show you again. Let me find it. Hold on. All right. We're going to write a story on here for grins. Triggers are moving averages. Price returns to the mean. And I think it's called, who is the smart person in here that said that it's called like the regression to the mean or something like that? So what that basically means is price returns to triggers, typically. Triggers are not a bounce point. They are just a moving average. So that's the first part of it. The second part of it is when you put an area. Remember, areas are Fibonacci based and they reflect the motion and movement of the market previously. These areas give the market something to bounce off of. So I expect, and this is a pretty good example of it right here. I expect the market to correct to the triggers. That's why I identify from the bottom of the triggers to the top of the triggers. But you can see, Cav, that it's already hit the trigger on the first bar up. And then when I give it something to bounce off of inside of the triggers, when I give it a solid point to bounce off of, that's where the market is most likely to bounce. And notice that it rockets right through the lower triggers and hits that area for entry. And it rockets, and it's pulling back, and I'm looking for these areas. So, and I'm not saying that there's anything wrong with your entry, not at all. But the triggers are just a correction point, and that's why when they're split, it pulls away the advantage. And that's why when you get in using the trigger as your point, what if it decides to go to this one, right? But when they're one on top of the other, and then you give it something to bounce off of, it really becomes easy. And what these entries off of the triggers and not the areas, see how it came right back to the fib? Well, missed it by a tick, right? That's like an extra 2 points. And it's an extra 2 points less risk once it starts to go. And you may see this if you scroll back through a lot of times where you get into the triggers and it still goes past you and hits that key area. And that's kind of why. And that's why when I see you saying, took my entry at the trigger, instead of took my entry at the areas inside of triggers, entry at the trigger, entry at the area inside of the triggers, what you'll find is that it creates this advantage, right? No triggers at a mid band, no triggers at a fib. There's your correction point. And of course here the rules aren't met. So what it does is it gives you this awesome advantage of being able to see not only where it's likely to correct, but what's there for it to bounce off of if it does actually make that correction. So both of your trades were led by the large chart. One of them could have been a better entry, it went, and the other one didn't. So the whole reason that I put that using the triggers is I want to make sure that your entries, what does your plan say? Does your plan say pull back to the trigger, or does it say pull back to the area inside the triggers? And I can't see what your entry price was. It was 52 something, it looks like. Or was it 57? No, your exit was 52. So probably 57. So how do you choose 57? Why not 55.75 where the trigger was? Lower. And this is it's just a consistency thing. It's so that you can repeat the same look that's bringing you success. That's all. That's the only reason that I bring it together like that, and why I think language for a lot of people becomes important. Because if you know my entry isn't at the trigger, it's at the area inside of triggers. If it's a trend trade. If it's a momentum trade, yeah, absolutely. And then if it's a momentum trade, I may say, well, I need to make sure that I'm on the correct side of the small triggers. And there's all these different variables that are pretty cool. And writing them on your chart, being very specific about your entries until it becomes second nature helps a lot. So, but I think that lesson may have been for more of the new people, Cav, than you, because I feel pretty comfortable that you know what you're looking for. But for you guys that are there, that lesson on the correction point and the area inside, it'll pay dividends until you get to Cav's level where you can read it in the moment. Not one trigger above support, right? Whoops. That's not my best look for a short. Weak triggers, but a clear path, but two divergences and no areas inside of triggers. Probably not my best. Actually, it looks like it hit support to the tick there. Isn't that cool, guys? Your fib stopped the market to the tick. Your rules for termination kept you out of the short. Did anybody go short hoping it would break because they didn't get paid on the way down? That tends to be the most common reason for trading into termination conditions is you didn't get paid on the way down. They went down, and you didn't make any money and now you're mad about it, so I'm going to break my rule for a short. I've done it. I don't know. Maybe I'm the only person in the room that's ever done it. I used to get mad at the market. Oh, it's not giving me what I want. It's not giving me the trades that I want. The market's the market. Guys, the market doesn't care about it. Didn't even know you exist, to be honest with you. The market is just ups and downs, right? So we wait for the patterns that give us the best chance. The market never wakes up and goes, man, let's make sure Cindy makes some money, right? Guys, give her the pullback to the areas because she's kind of nice. She's got that Miami sound machine vibe working. And Mario, though, don't give Mario any pullbacks. F Mario. We never liked that guy. Heard he kicks puppies. It's not like that. The market doesn't care. They don't know. But what we do know as next-gen users is that without momentum, the market is less likely to continue in the direction. And with no triggers through an area, the market is less likely to continue in the direction. So when I get no triggers through a high and no triggers through a low, I instantly have this unbelievable advantage where I can say, you know what? Until I get a breakout, my best option is to do nothing. And it's boring. Does anyone else hate waiting for trades like I do? Ugh, it's boring. I can't go long. I can't go short. And right here, you're like, I'm still cool with it. I love my rules. And right about here, you're like, I'm getting a little bored. Maybe, yeah, that's a good top. It's a good top. It's definitely going down. There's no doubt in my mind it's going down. Well, my triggers are still up. And then I see the background change, and I'm like, oh, I knew it. It's a good top. And look at that red background, and my small triggers are below the large. Guys, I have odds favorable momentum. And you're like, yes. And then you get run over. And you're like, son of a bitch. Guys, these are the areas where opinions are formed. These are the areas where rules. It's like deer hunting. Rob, I hate deer hunting. I'm not going to lie. I love my friends that deer hunt because they give me venison, and I love venison. But I can't sit in a stand that long. I start shooting trees and dandelions, and I scare all the deer away because I can't sit there and do nothing. It's so boring. I do my hunting at the grocery store. But does everybody see how easy it is? How easy it is to convince yourself right here that if you just take the short, you're going to be the first one in, right? If I just get in at that mid band, I'm going to be like, everybody's going to love me. And then it does this, and you're like, oh, and that just blew out my account. Was it a terrible trade? All right, Jen. Man. I want you to grab a box of tissues real quick because you've been with me long enough. It's time for tough love. So, termination condition into the midband. It's not ready to go. Termination condition is verified when no triggers break and a second lower divergence. The move down is really just almost cast in concrete at this point. Third divergence in the same area. Everything is screaming down. Market hits the one-to-ones. And then when it hits the mid-band, gap theory, everything says down. Every indicator's down. That was your mid-band right there. And then you get below all forms of trouble. You're in the momentum phase from a mid-band where the large triggers didn't flinch, and you ride the momentum all the way down to the key area, and rather than hoping life stays great for you, you exit at trouble. Jen, I have traders that would dream of being able to catch crap the way you catch it. A little chart reading goes a long way, doesn't it? This creates a bounce all the way to the mid-band. Did you notice it? Nothing really changed, right? It's just right into the mid-band. And right here, everything agrees. And on your small chart, synthetics are down, larger down. But I want you to take all the focus off of the synthetics. And I want you to see the odds favorable momentum on that small chart. And then, so where's your trouble? If you're going to take that jump in trade, you get through the one-to-ones, and that's a trouble spot, right? And the triggers are strong. If you sell into the divergence low, you have to be aware. If you sell beyond the divergence low, it's pretty much smooth sailing. I love this trade, Jen, and I think that it's a great read, and I think that the patience that you put into place is outstanding. And because it came from a great top and lower divergence, and the large triggers didn't really blink so much, and it's right off the mid band, you're just looking for that continuation to the next key area, and you got it. So, sorry, I'm not going to beat you up on this one. That was a terribly good trade. And it's a lot smarter than you realized. I love that trade. Isn't it kind of cool, though, when you put a chart read on it? You're like, oh, wow, wait a minute. Maybe this wasn't so bad. Nice job, Jim. Does that make sense, everything that I said? You thought you got lucky, right? You thought that you got lucky, and you're right, it's not the KISS plan. So if you're holding yourself accountable to the KISS plan, and the only trades that you're supposed to be taking are the KISS plan, well, then let me give you one of these. But here's what I need you to do. I want you to go back and annotate this chart, and I want you to talk about the three divergences, and I want you to talk about the idea that nothing changed off the midband, and I want you, and then it's perfect. Then it's perfect. And that's one of those things where it's cool, right? The second lower divergence was great. And then the third lower divergence is like, oh man, no matter what the buyers try, they can't seem to do it. And let's go back to the idea where decisions are made, right? And we can't see all of it on yours. And since this is the last picture, we're just turning it into bigger and better lessons. So the market was going up, and it was going up, and it was going up, and it was strong triggers into resistance. And that meant that there was a lot of force going into that key area, and the sellers tried to push it all the way back down to the midband. But because of all that force up, the buyers probably weren't done. And it's not a coincidence that they made it directly to that key area. And do you see how the sellers steal it a second time? And what does this mean? This means that the buyers reach their spot. And then when they push back down and they break through that midband, you can see that the sellers are saying, okay, they're there. And the sellers had their spot reached. They were waiting for the buyers there. And then when they pull up, the buyers go, let's fight one more time. And the sellers say, nope, it's just not going to happen. This lower divergence pretty much cements. The sellers are angry and they're pushing hard. So when the buyers push right back up to that midband and can't break it, you better believe, Jen, I'm looking to go down with those triggers as well. And if you look at what happened at the top, and we go back to termination conditions, kind of strong triggers into a fib, divergence prints, comes back, retests, pivot, stop out, down it goes. It's a beautiful pattern that repeats itself all the time, and you did a great job recognizing it. There's your confirmation, and there's your opportunity. And there was a lot of waiting to get there, but eventually you did get there. Breaks out of the range, hits the next termination, and dag nabbit, there just wasn't an entry. Termination creates a reversal, reversal into trouble, all the way back to support. No reason to try along on those big split triggers coming off a termination. No reason to try to buy here. No reason to fight the triggers. And it's still just a 50-50. So we're just trying to get our rules met. And Jen, it makes me happy when people post in the room that it was a terrible trade, or even on the same token, and this is why posting in the room is so important, is I'll have someone post in the room, they're like, man, I took this trade and I just lost, and Mark, what did I do wrong? I can't figure it out, Mark. What did I do wrong? And I say, well, you know what? Let's go through your chart. And you had odds favorable momentum, and you also had a clear path, and you took a beautiful entry right inside of favorable large triggers. And when you post in the room, you're feeling a little dejected. You're feeling a little beat up. You're feeling like you did something wrong. And I'll see people post charts like this. And this is why I think posting in the room is so important. And they'll say, well, that divergence must have killed it. Those small triggers up against me must have killed it. Maybe I was too close to Fibonacci support, and that must have killed it. And the wonderful thing is that when you post this loser in the room, guys, what you can do is you can remind yourself that anything that wins 70 out of 100 times loses 30. And it's okay. And when you were feeling bad and like you made a mistake, you come back to the room and you're like, wait a minute, I did everything right. And it really does, guys. It helps boost confidence. You tell me, Mario, what do you see? What direction is it going? I can read charts, guys. I'm good at it. Help me out. Is it going up or down? No. Is it going up or down? Mario, take a picture and write your rules for a momentum trade on the chart, please. You think it's going down with the green background? All right, we're going to go through a whole truckload. If the background on your large chart you said crude oil, right? Is what you wanted to analyze? Okay. So what direction is the market going? Up or down? All I'm looking at is the background. It's going up. So let's go to our first advantage. Do I have odds favorable momentum? Do I have strong triggers? Give me a Y or an N. This is rule number 1. Okay, so now we go back to our first lesson. Mario says that we do not have strong triggers. So Mario, let's define strong triggers. Because if you can't define strong triggers, well, then how on earth are you ever going to take a momentum trade? Strong triggers means that there's a separation between the small and the large. So in an uptrend, when the small triggers are above the large triggers are wide, this is the strong trigger look. This is momentum. This is the best of the best. In a downtrend, it looks like this. On that same token, let's go to, let me open this up real quick. Strong triggers, and then here's your weak triggers when the smalls return inside. Does that make sense, Mario? The recipe for strong triggers is smalls above the large, larger wide. So let's go back and we'll just ask again. Let me pull it up here. What do you think? Strong triggers? Smalls above the large, larger wide, space between, the scissors are open. The odds are favorable for the market to continue in the direction of the trend. Absolutely. And all I'm doing, Mario, is I'm not looking for a trade, right? I'm looking for my advantages to be in place so I know whether or not I should be looking for an entry. So I'm going to take the most current bar, and it reached the 1-to-1s, and it reached Fibonacci resistance. So I'm going to very cleverly write price reached an area, but my triggers are all below. So rule number 2. Is there a termination condition? What do you think? Is there something that could reverse the market, that could create a bounce, that could really screw up my plans for the day? There is a termination condition. So this is where you have to ask yourself, Mario. I do have strong triggers, but I also have a termination condition. Am I willing to break rule number 2? If you are, rule number 2 says, or rule number 3 for entry says, I will buy a pullback at an area inside, you know what, of favorable large triggers. And man, I love doing this because this is exactly how I speak to myself. When I'm looking for trades, I talk myself through trades like this. And I'm gonna make this one bigger because I think that this is the key to the best of the best, is that you buy a pullback in an area inside of favorable large triggers. So Mario, if I go from the bottom of my triggers to the top of my triggers, do you notice that my areas are on the wrong side of that correction point? All these areas are below the triggers. They're on the wrong side of the correction point. Does that make sense? So when I go through it and I say, okay, trend is up. I do have strong triggers. Rule 2 not met. Rule 3 not met. So it's not a trend trade, right? Because I've given up 60%, 66% of my advantages. I don't have a clear path, nor do I have an entry area. So, and this is where you said, yeah, okay, momentum trade. And this is where that momentum phase comes in. I'm already on the wrong side of my small triggers, which is the wrong side of momentum. And I want you to see what it did off the termination condition. Kind of cool, right? And Mario, thank you so much for bringing us into this one, because what you just did is you reminded everybody in the room that it's either rules met or rules not met. And there's going to be a point where it's easy, where the path is clear, where the momentum is the strongest. And then there's going to be visually where you can understand where maybe it's a little problematic. And it doesn't mean that the market is done, right? It doesn't mean that it won't go up. But if I put that rectangle around the most current bar, all of this is happening inside of the bar because they reached a decision-making point. So what you're literally able to witness on a smaller chart is they reached where the buyers were trying to get, and the sellers pushed immediately. And then the buyers, less of them, gave a little shove, and the sellers pushed back. And that immediate momentum is on its way down, and it's giving no signs of breaking just yet. But the large chart keeps you from having to guess on the small chart. The large chart keeps you from just entering all willy-nilly on a smaller chart because you just don't have a clear path. I hope that makes sense to everybody. And that's kind of what we do. Is we just talk in advantages. So I encourage you guys every time. Every time you look at a chart, go through that process. Let's go to another chart. Let's do a read. Market's going up, right? Give me a Y if you see it, guys. The market's going up. And the market also has strong triggers. And there's that darn no triggers through the area again. Do you see it? All I'm doing is talking about advantages. I have momentum, but I don't have a clear path because my small triggers haven't broken through the area, which means that I'm in a holding pattern. If I'm going to look for a long trade, for me personally, it's important that these small triggers smash through the area. Otherwise, this is an area likely to stop the market, likely to create a bounce, likely to be a fighting point between the buyers and sellers. Does it mean that the market is guaranteed to go down? Absolutely not. But divergence supports the idea that it's less likely to break. So this is where people ask, Mark, how do I get into the market when the rules aren't met? Well, you break your rules. But that's a decision that you have to make. That's not a decision that I can make for you. It's kind of fun though. When you learn to trust your rules, when you go back and you see these looks over and over, guys, it really does make life easier on you. And this is the NASDAQ, and my small triggers are below the reversal bar marker, which for me is a no way kind of thing. So since there's no pictures, we're going to go through my rhetoric. Guys, to minimize your learning curve, post pictures of your trades in class. And all I'm doing is I'm gauging your chart read. Because one of the most common problems with new users is trading in half-truths. Trading in, well, I believe this is a clear path when it's actually a 50-50. Or I'm certain that I have odds favorable momentum when it really is a weakening of the triggers. Or I'm taking the correct entry on the pullback to the triggers when you keep getting run over because you're not waiting for the areas inside of favorable large triggers. So I want you to post everything that you do in the room. I want you to post every question that you have in the room. I want you to, if it's just a chart read and not necessarily even a trade. Guys, if you notice, I'm like, hey guys, post them if you got them, and nobody's posting, why not just do this? And go, hey Mark, I'm working on this. That's a termination, right? And I'll be like, heck yeah, great read. Awesome. Or maybe you come over here and you go, hey Mark, that's split triggers, right? And that takes away the advantage because I'm not sure where it's gonna retrace to. And I'll be like, yeah, great read. You know? You'd be like, but that was a good bottom. And it doesn't have to be a trade. It just doesn't. So post everything in the room, guys. Every trade, win, lose, or draw, every chart read. Right or wrong, get feedback. Work on becoming a chart reader. Because if you win and the rules are wrong, you have a short-term victory, but a long-term failure. The market will allow you to win just enough to build a false sense of security. And then from that false sense of security, you're going to begin breaking your rules. And then you're gonna lose, and you're gonna be, oh man, I'm so mad. That termination condition held or broke that one time, and I should have gone long. But that termination condition didn't break. And that one didn't break, and that one didn't break, right? And look at that one hold. And look how that one held, and that one held, and this one held. And guys, is it just me? Or do we call this stuff like a boss? You know where high and low is going to be. You have the greatest advantage in the world of knowing where the people that make decisions are going to make decisions. And guys, that was like a quick little run on NASDAQ. From support into resistance, back to support, off it goes. Doesn't reach their target, pulls back to support, makes it to where they want to be. Confirmed. Resistance holds, all triggers below. Support creates the bounce into the mid band. Right to support, straight to resistance, back to support. And guys, now we're at resistance and none of the triggers have broken. And where you thought you got away with one, hey, look, I knew that it was going to go up. You still haven't broken the area. And now your smalls are on the wrong side. And guys, I'm just telling you, there's an easy way and there's a difficult way. So post everything in the room, guys. The idea is that you can get feedback. We can talk about your chart reads. And you're going to see a termination condition break, and you're going to think that you should trade into every termination condition. But that quick little snapback over the last 30 minutes in NASDAQ shows you that they do, in fact, hold more than they break, which is why we wait for them to break. And if you're on simulator, guys, you're participating in class, you can't lose money. That's the beauty of it. Everybody wants to try too soon. Everybody wants to be a day trader instead of a chart reader. Everybody wants to get rich rather than learn, right? If you're a brand new engineer, you don't get to build a bridge your freshman year, guys. In college, learning to be an engineer, you've got to go through, you've got to work with people, you have a mentor, and eventually you're going to put the plans together for a bridge. But until then, why get caught in the nonsense? Right? I don't just teach you the patterns, guys. I teach you how to study the patterns. I teach you how to recognize the advantages. I teach you how to identify the entries. We talk about stop placement. We talk about two divergences on a 50-50 as a horrible way to go long. But you're still going to do it because it sucks to do nothing. So post it in the room and we'll talk about it. I'm here to help. You need someone to tell you what you did right or wrong, guys. That's all I do every day. As we talk about right, we talk about wrong, we talk about terminations, we talk about advantages. And two divergences on a 50-50 is not an advantage. One divergence into a termination condition is not an advantage. There may be a time where you get long here and out here and you find a way to make $100 in there every now and then. My brother is the best I've ever seen at it. But for us mortals, it makes more sense to wait for the clear path, to have the advantage of momentum and all that good stuff. We've got 10 minutes or so. What do you want to talk about? Guys, I shouldn't ever talk this long. You guys, if you're learning the software, you should be posting in this room so much that you're afraid you're annoying me. You should be asking so many questions that you call your wife later and go, man, I hope I didn't upset Mark with all the questions. Because I'm going to call my wife and go, God, I loved it. They asked so many questions today. Today was the best class ever. And she's going to be like, seriously, I'm in surgery. Don't disturb me. You know how they are. Mike Silence, just want to shut it down? Should we call it a day? I'd rather teach. All right, you guys are going to make me go find silly pictures. Here we go. Bum, 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 bum. Nexgen's been teaching the same darn thing for 27 years, guys. Identify a termination condition. If it holds, look for shorts. Your first one's that HVA trade. Gary dropped one in the room earlier, and it was beautiful. After the HVA trade, if everything is strong, you're going to look for a trend trade. If you get the trend trade, you're going to keep taking it until you reach a termination condition. And if that termination condition breaks, you're going to go back to looking for trend trades. And if it holds, you're going to start the process the other way. And guys, this has been in place for 27 years. 27 years, Nexgen's been teaching people to read indicators, to identify advantages. For 27 years. Bad top. Everything says down. Divergence on a 50-50. And you lost. So guys, everybody has a thing. Everybody has a thing. Everybody takes the same trade over and over until they lose it so many times, they finally get sick of it. So a bad top, you identified it. A bad top means that it goes past the decision-making point. And that's strike one for the 50-50 trade. Divergence after a bad top, that's strike 2 and 3. This is so not likely to win because they exceeded the decision-making process. They didn't clear the areas. Divergence is printing. The small that's weak, and you have split triggers. And Haji, you're still inside of the triggers, brother, which means that your window of opportunity, you're out while you're still inside the window of opportunity. So you didn't even give it a chance to fail completely. Does that make sense? So let's go into an alternate reality. I know it's a bad top, and I know divergence printed, but my window of opportunity is still pretty big, right? So it's not the best trade, not the ideal setup, not high probability trend trade. Hey, take care, Cav. I'll force the ES to give me a reversal bar before I commit money to the trade. So Haji, I'm not saying don't take it. Cav, take care, man. But what was wrong with that one without divergence? Why didn't you take the one without divergence right off all the areas with all that momentum? And strong triggers. And look, smalls outside of the large. Because it was in between. All right. I don't think I have the S&P up. And it doesn't look like there's been a lot of opportunity on the S&P today. Do you trade the S&P exclusively? No. Crude oil as well? Okay. So let's do this. This is just me for grins. I want to see. That's the first shot. Probably not a high probability trend trade. Not gonna lie. I'm not expecting this to be one of the trades that I'd be super excited about. But it is that momentum style trade with everything on the right side. Not a high probability. If you didn't take this one, that's cool. I get it. This one is a clear path off a termination condition. Everything says down. No divergence, strong triggers, perfect pullback. I like that for an opportunity to get to the next key area. That one's kind of sexy. There was a 50-50. No worries. But you don't need them. There hasn't been a ton of opportunity. It's Monday. It's a little slow. So if you're trading the S&P, if you're trading crude oil, guys, there may be 5 or 6 trades some days. And it's okay to not be cool with the momentum trade. But this is one of those things, and guys, this is one of the great conversations that I had over the weekend. You got to sit on your mouse hand. Um, and let me see. I'm going to go back real quick, and I'm just going to get a little idea. And I'm not going to share who shared it, but I want you guys to catch this. So the question was, I was thinking about trading this morning, and I was wondering if your brother had any insight on this. Not me, my brother. The question is this: as a trader, the longer we sit in front of the computer, can it have an effect on our breaking the rules? For me, I'm seeing this happen to me. This morning, my wife and I talked about this in length. I trade really well until I get to my goal. And then instead of stopping, I find myself thinking in my mind that I can do something different, that it will work. I'm at the point now that I need to get to my goal to shut down on my computer. Just a few thoughts this morning. Would love some feedback on this. Have a great weekend. I love to have a great weekend because I did. I had an awesome weekend. So guys, I'm going to show you my response. It sounds very familiar, doesn't it? We all love to believe that it's only us, right? We're the only people that are going through this, and the reality that it's not. And this is why I want to share it, because I think this is such an important part of what we do. So let me do my response here. This is what I said. Ooh, that's really big, huh? That's okay. And I told him, you know what? I think I covered this Friday. So things you have to know before you ever sit down. And the first thing is what are my rules for entry? Right? So if I don't know what it takes to get me in or out, then I have nothing to follow. And this is where challenges begin to come into play for new users, is boredom begins to fabricate trades. And then one of the second things is you have to know what your management rules are. So if you did have to wait 3 hours for a trade, are you going to instinctively try to get more out of it because you're afraid that another one isn't coming? And this is a big one, and I see this in everybody. What's my daily goal? And what is my stop loss? And these are the two most ignored parts of a plan, but they're really the most important part of the plan. If your plan says $500 a day and you're at 600, you need to stop. And if your plan says lose $350 a contract and you're down 700, you need to stop. And if it's not clearly drawn out, you're prone to let adrenaline, opinion, fear, greed fuel the moves that you make. And sometimes the market is slow and you sit and sit and sit. And there's a reason, guys, there's a reason that I take breaks in the mornings. And I suggest that all of you do it too. And I say it every day. I'm going to stretch my legs. You guys should do the same. If you sit too long to look for your trades and not your rules being met, you've got to go run a lap. You've got to just say to yourself, man, this is the time where I get in trouble. This is the time where I make bad decisions. Let me make it a little less huge and ugly. We'll go Arial Black. Oh, maybe it's because it's just zoomed so much. And this is one of the biggest things, guys. If you see yourself looking to take trades rather than follow rules, it's a great time to stand up. It's a great time to go away. And I thought that he was spot on. And if your goal is 1,000, it's okay to go on sim after you hit your goal. And it's greed making you pull the trigger live again. And then if you lose, you're below your goal. And then that's fear making you take another, because we all know that we can get it back with just one trade. Has anyone ever said that? I know that I should stop trading, but I think I can get it back with just one good trade. But it's like going to Vegas and gambling scared. If you go to Vegas with 10 grand and you lose 9,900, you're going to make a bad decision with that last 100, hoping to get the 9,900 back. And guys, I'm telling you, and I shared this in the room or in the message, guys, I've blown out days having been up twice my goal because I begin to feel invincible, because I begin to chase that dopamine kick. And I abandon my plan. And I could go on for days with it. Um, and this isn't anything that really has anything to do with Nexgen. It isn't anything that has anything to do really with anything other than have a plan. And I'm trying to save it here. There you go, Jen. But I really do talk about it every day. One of the first things I say on my introduction to the KISS plan is that if you don't have a written plan, guys, you don't have a plan, and you're subject to emotion and all that nastiness. And if you don't have an exit plan, it's just as detrimental. And if you don't know what kind of trade you're getting into, you don't know how to manage it. And I know that we all want to be rich, right? Everybody wants to have everything that they've ever seen everybody have. Everybody wants to eat steak every night. We don't want to fry up a little spam on Tuesday, but it's not your desire for wealth that's going to bring you wealth, guys. It's the process. It's the idea that each and every time you enter the market, you do it with a statistical advantage. Every time you pull the trigger, you're not pulling the trigger because you're hoping for a win. You literally have absolutely no idea if you're going to win or lose. You never know if you're going to win or lose. So when you stop expecting to win every trade, you're going to find yourself winning most of your trades. When you focus on the execution and don't worry about the result, guys, that's when you turn a corner. That's when you become a professional day trader. When you know that you're not in control, when you know that it's just ups and downs, that you know it's nothing more than ticks, and your angst and grief from losses are self-imposed. And your expectation of wins create that grief. So the idea of this classroom is to give you a solid plan that says, hey, guys, I know that you're new and I know that you're learning to read your charts and I know that you want to make money. Let me give you the easiest way that I've found, the easiest way that Nexgen has ever put it together in 27 years to optimize your chances of success. And until you're comfortable with this, I want you to do your best not to deviate it. But guys, I'm a huggy squeezy kind of guy. You are going to deviate from it because you will form opinions and you will break your rules, and I'll never beat you up for that. And I'll remind you that you're doing what everybody does, right? But I can tell you through my own experiences, having learned the indicators, having followed the plan, having tried to avoid the best chance of success, and having embraced it, that it's doable. It takes a little bit of work. It takes a lot of patience. But the reality is the payoffs are outstanding, guys. I make more in a day trading the markets than I ever made as a general manager for a restaurant, or that I have ever made in a day working for Nexgen. So I promise to be with you for your journey. And I promise to keep teaching you to read your indicators, and I promise to keep critiquing your plans. But if you find yourself going wayward a little bit, if you find yourself getting outside of your comfort zone and taking more losses than wins, I want you to promise me that you'll post in the room, that you'll regroup, that you'll go back to the KISS plan if that's what you feel is best, because I won't tell you when to trade or what to trade, and that you allow it to be simple. Absolutely. But the key is 100% is you have to speak to yourself in terms of advantages, and you have to know what your rules are. And then once you do, once you know without a doubt that this is the recipe for a trade, you'll recognize it at a moment's notice, and you'll take the trades you're supposed to take, and you'll find it's easier to avoid the trades that you couldn't. And Mario, thank you. And Rob, thank you. And guys, I have to tell you right now, that it's not that I'm awesome. It's that I've screwed everything up 100 times, and I'm just trying to keep you guys from doing it. And then Asa did this many times. It's kind of like a child who wants to touch the stove after parents say not to touch the hot stove. Some people learn after touching the hot stove once, some people twice, 3 times, etc. You're pretty hard-headed and you learn after being burned a lot. What finally clinched it for you was a simple fact. As the day trading goes on, you've reached your daily goal, your trades become lower in probability. Why fight that? Why don't you take your wins and wait for the next day? Why not go away and enjoy the rest of your day as a winner and come back the next day feeling good about this business of trading? Man, Asa, thank you. That's perfect. And that is so true, 100%. And Rob S., you never miss a trade. Because when you miss a trade, you have to make up for a trade. You either didn't recognize it, your rules weren't met, you weren't in the position, everybody poops, right? You never miss a trade, but you have to find out why you didn't take it. It just wasn't yours that time. That's all it is. Leave the emotions out of the trade. That's the hard part, Mario.